Hello everyone, good afternoon and welcome to day 3 of this wonderful refresher course on Companies Act, focusing on auditing. And today we've got again, just like past 2 days, we are very happy, we are thankful to each one of you. The feedback that you've shared, some of the questions that you've been asked, that shows that it's quite an engaging conversations that we always have. And through webinar mode, we are making sure that we try and make sense out of the time that we are spending here. I'm really happy for all the faculties, that those who have taken out time. And today we've got one another expert faculty amongst us, CA Padmashree Crasto madam. I've got a privilege of working with her earlier, and she comes from a very strong research background. So today when we talk about auditors responsibilities and documentation to ensure compliance with Companies Act, I think very key small little things, but they matter a lot. I think all of those things would be covered in a very some things that we don't feel would have an impact, but later on when it hits us, it becomes very important. So I think all of that will happen today with a very in a lucid manner. I think Padmashree madam has this good art of delivering it. So thank you madam for taking out time. To start off with, may I request Sharon to please introduce our faculty for all the audience, and then we can take off.
Yeah. Good afternoon, everyone. Yeah, let me introduce today's faculty as first faculty of the day, CA Padmashree Crasto ma'am. Yeah. She's partner in MSKB and Associates LLP. She operates out of Mumbai office and has over 16+ years of experience in practicing auditing services across industry verticals of insurance, financial services, and manufacturing. She is also in charge of keeping the audit team well informed of the latest technical developments in various statutes and regulations. Also, she is responsible for the quality assurance function in the audit and assurance services, which includes review of deliverables, conduct of online review, cold review of audit files, and thereby managing firm risk. Also, to add upon her professional experience, she possesses in-depth knowledge of standards of auditing, both Indian as well as international auditing, in-depth knowledge of quality standards, IFRS, Ind AS, IPO-related matters, and other statutes. Ma'am also imparts training programs on technical quality methodology and other professional interests. She is also a great contributor to the WIRC publication, Anthology on CAM and other reporting matters. So welcome, ma'am, to our today's session.
Thank you, Sharon. I also welcome other coordinators, CA Suresh Jain, in this conference. Madam, over to you, please.
Thank you so much. Thanks, Arpit, and it is always a pleasure working with you. And thanks, Sharon, for the introduction. Quickly, for the benefit of all, I'll just share my screen. Please confirm if you can see the screen, please.
Perfect, ma'am.
Yeah. Okay.
Yes.
So here we are to discuss, I think, on the third day of this Companies Act series. Here we are to discuss on the auditor's responsibility with respect to documentation. First of all, auditors' responsibilities under the Companies Act, and especially documentation to ensure compliance with the Companies Act. One of the important and most important things that we believe in as auditors is, if work is done, it has to be shown by way of documentation. If there is no documentation, it means work is not done. It's equivalent to that. So any work that we do, anything that we do, has to be properly documented. If we cannot see the documentation, then work is not done. We can actually think about that in that manner. So we do not manufacture any product. Our product is our audit report, and to support that we have to have documentation. One basic thing that we all know, what SA 230 and all other auditing standards tell us, is that we have to have sufficient appropriate audit evidence to issue an opinion. If we do not have sufficient appropriate audit evidence, then our audit report cannot be clean. I'll briefly run through the auditor's responsibilities first, and then go through the documentation. So it is basically intermingled. I have tried to kind of plot both together and try to discuss it along the way. So during the session, please, if you have any questions, please feel free to post it in the question answer box or in the chat box, and we will be able to take up the questions at the end of the session. Please feel free to put up your questions as and when they pop up or at the end of the session. So responsibility of auditors, first and foremost, we start with the prime responsibility of ensuring compliance with code of ethics. So we all know the appointment formalities and everything, but prime thing that we have to always keep in mind and what we have to look at, sorry, is the screen visible?
Yes, ma'am, it is visible.
Sorry. So the first and foremost requirement is to ensure that we comply with the ethical standards. So as an auditor, what is of prime importance, the point that I have mentioned here is that section 144, this is of prime importance. Code of ethics has also undergone a change in 2020. We all know that, and there are specific code of ethics sessions also are run by WRC as well as various other regional councils, which is mandatory, and the enhanced code of ethics will apply. Some of the things that have been brought into the Companies Act itself by the Companies Act 2013, those are this prohibition on non-assurance services that cannot be provided by a chartered accountant, which was already there in the code of ethics but very specifically brought into the act itself. So this is the prime one, which is of highest importance, and that's why I thought we should make a mention of it when we are talking about the auditor's responsibilities under the Companies Act. Going ahead, what are the powers and rights of auditor? So he has the right to access to books at all times and of all the branches and of all the units and everyone and every place. So let's take a simple example. If the company has location 40 locations, say 30 are go downs, 10 are branches, 15 more are operating offices, it is the prerogative of the auditor who can pick and choose which branches he will audit this time and how he will consolidate if he is the sole auditor of the entire company. So he has a right to access to all the books of account. Now books of account, as we all know, is a very broad term. Books of account does not mean only the financial books of account. There are financial and non-financial books of account. When we talk about non-financial books of account, they are all everything that is comprising of minutes, registers, other vouchers, other detailing that are required. So if we take an example of a GRN, whether it forms part of books of accounts, yes, it does form part of books of account. Minutes of the risk committee, whether it forms books of account, yes, it does. We all know all these things and the integrities and the nitty-gritties. So all the books and records and all the documents have to be made available to the auditor very much. Second right is right to obtain information and explanation from officers. So we conduct audit as per standards of auditing, which is under 143(10) of the Companies Act, and the standards of auditing actually tell us the things about how to perform an audit, which includes techniques of audit, inquiry, observation, verification, right, and proof in total. So when we are doing all these things, we actually obtain a lot of information and explanation. Few of the things that we also take it in representation is that whatever management representation, you have been truthful to me and you have made a proper representation. So there is also, even if you see under the Contract Act, because ultimately audit is also a contract, under the Contract Act, if you see, if someone deliberately misleads someone, then that person will not be liable to. But then the auditor is in such a prime position and there is so much of law and obligation around him. So to establish that you are not party to it, it is very necessary, and documentation is the only thing that is going to help us. So it is intertwined. And how do you obtain information explanation? It's not verbal information explanation and one-way recording. You need to maintain minutes of meeting, you need to maintain all the discussion, you need to maintain all the kinds of additional things that you actually interact and then get an email confirmation if necessary, and also the written representations as the case may be. So you have the right to obtain all information and explanation from all the officers. So under Companies Act, officer means director, manager, every other officer who is responsible to perform his duties. So all officers are supposed to give you information. Right to receive notices and attend general meetings. So this is another right. Any kinds of notices where an auditor is to be dealt with, or anything that an auditor is to be doing with. So you have a right to receive all the notices, and you also have a right to attend the general meeting, though you can seek an exemption from attending the general meeting, but there is a right to attend a general meeting which is given by the Companies Act 2013. Earlier this was not there. Right to report to the members of the company on the accounts examined by him. That is your prime right as an auditor. You are going to report on to the members of the company on the accounts that are examined by the person, that is like whether it is true and fair, and the specific reporting that one has to do under 143. And then right to lien. So this right to lien is a slightly different or a complicated thing. It's not about right to lien to books of accounts and things like that. His working papers and his things are his property, and it is those things that he can keep with himself. Under code of ethics, you cannot hold back the auditor's report if fees is not paid, but unpaid fees is definitely hurdle to your independence. Inquiry. What all inquiries do we have to make under what is the responsibility of the auditor? What all inquiries we have to make under section 143(1), because the sections from 139 to 144 are the sections up to 145 are sections that deal with the audit and auditors. So the entire discussion will revolve around these things. So what is it that we have to inquire with respect to our audit? Other than, I'm not touching upon each and every area, like how to audit a PP or how to audit a say borrowing and things like that. I'm specifically going towards the requirements of the Companies Act and what are the specific responsibilities cast upon the auditor when we are looking at from the Companies Act angle and the documentation relating to that, the overall compliance. So we are going to inquire on the following matter with respect to 143(1), loans and advances made by the company on the basis of security, whether they are properly secured and terms are not prejudicial to the interest of the company or its members. Prima facie, whenever we are looking at Companies Act and whenever we are complying with the Companies Act and whenever we are looking into the compliances of the Companies Act, the first and foremost thing that will always have to be remembered is there any transaction that is prejudicial to the interest of the company? The whole precinct of the Companies Act sits on or depends on a principle called whether it is prejudicial to the interest of the company. So if something is prejudicial to the interest of the company, there are no two ways to look at it. So it is obviously not allowed by the Companies Act, and that will have to be brought to the attention of the members or the shareholders of the company. And if that is not done on a timely basis, there's a lot of responsibility that will be cast on the auditor, and then he will be held guilty of maybe professional misconduct if it is done intentionally and not unintentionally, but that has to be proven. So number one, we have to make the inquiries about loans and advances which are made by the company on the basis of security, and whether the security is properly offered, it is properly secured, and whether the terms that are there are not prejudicial to the interest of the company or their members. Then next inquiry that we are going to make is the transactions of the company, whether it is merely by book entries are prejudicial to the interest of the company, whether there are any entries that are only book entries. Question number one is, we will have to actually analyze, inquire, observe as to whether there are any entries which are only book entries. What is book entry? It's basically without any exchange of goods or services or money. It's just an entry that is passed in the books, and if there are any such book entries, whether they are prejudicial to the interest of the company. For example, to lower the profit or to increase the profit, if there is an entry passed which is actually completely it doesn't have any substance, then such kind of entries are prejudicial to the interest of the company. Then in case of a company being an investment company or banking company, the shares, debentures and other securities have been sold at a price less than that which it is purchased by the company. This is very tricky situation. I'll just give you a simple example here. There was one case that I have heard of, wherein there were certain investment in shares and securities in an IPO by a company. So company subscribed to some IPO, and the prices did not pick up well. And after waiting for some months, because the company thought that the directors and the managers thought that in goodwill, not prejudicial to the interest of the company, they genuinely thought that the company is losing on money, why not make it good? And they withdrew the money from there within the same year, I'm saying, and then they actually invested in something that is more lucrative. 1/10 of the shareholder went and actually complained against the company that they have done a transaction which is prejudicial to the interest of the company because they have bought the shares at a higher price and they have sold it at a lesser price within a certain span of time. So we need to be careful of such things, wherein if there is anything of this sort, we need to be carefully observing. It's not about calculating the profit or loss on the sale of shares. It's more about applying the principle as to which direction it is going into. The next thing is loans and advances made by the company which has been shown as deposits. So loans and advances that are made by the company which are in the form of deposits, then we need to inquire about it and what is the, what, why, how of these things, and we have to ensure that it is appropriately accounted for. Any personal expenses that are charged to revenue account, this we are hearing from, I think, almost ages and ages, that whether there are any personal expenses that are charged to revenue account, and if there are any such personal expenses, I think this is one of the things that are there in the Income Tax Act also. So if such thing is there, then that has to be actually specifically brought out to the notice of the shareholders. In case shares are allotted for cash, where the cash has been actually received and position as stated in the books of account and balance sheet is correct, regular and not misleading. So if we have issued the shares, you have to receive the cash. If cash is not received, then that has to be reported. Typical example here, memorandum or subscribers to the memorandum of association. There have been 1 or 2 cases which I have come across, wherein the subscription money has not been bought in as yet, and there is a year end in between. Company is incorporated in January, say in December, but they have to bring in the money within the stipulated time. They have not yet bought in because of some FEMA or other approvals that are pending. So this becomes a very typical situation, whether this needs to be reported or otherwise. So carefully we need to think about and evaluate all such situations, and we need all substantiations and documentation to actually go through. Next, we come to the audit report, in which we have to specifically report on certain matters. There is a lot of matters. Earlier, I know there used to be only 3 matters when I started my career. I think now it has gone up to A, B, C, D, up to E, F, G, and G and H and I, and also, and then it will, I think, in 4 or 5 years it will reach Z, I guess. But there are so many matters that we have to specifically report on, with wherein the auditor is cast upon a duty to ensure that these things are appropriately reported. One thing I would like to state, this is my personal opinion. One of the things that is generally view, that is, there are 2 schools of thought basically. So 143.3 asks us to report on a host of matters, say 10 matters. There is a thinking, or there is a prevailing school of thought which says that if there is any matter other than this, if in other section if I find something, for example, a whole-time company secretary is required to be appointed, but he is not yet appointed. The process time is like, say, 6 months, but the 6th time is elapsed. So whether to report in the auditor's report or not to report, it's a material non-compliance of one of the sections of the Companies Act. Now, it is my view that it has to come under legal and regulatory matter. It may not be a matter that will affect the true and fair view of the financial statements, but it is one of the non-compliances, and when we are reporting under legal and regulatory reporting under SA 700, I think we can very much include in that. But the school of thought also exists that it is not required by us to be specifically reported, so we may not report it. So that kind of a dilemma also exists, because there are some material sections, if there is a non-compliance, then no one stops us from reporting it. So 143.3 never has that thought that it has to be limited by, it is not a limitation to scope basically. It is wider in scope, and then if something else is to be covered, we can very much cover. It is not putting up a limitation to scope at any point in time, is how I how we understand or interpret it. So first requirement is whether the auditor has sought and obtained. First is sought, that means whether I have asked for. If I have not asked for, then obviously I cannot say that I have sought. So just to connect the dots, seeking the information, how do we seek the information? We need to send the requirement list. So documentation with respect to compliance, here in each of the points I'll try to cover as much as possible. So how to seek the information? When I seek the information, I need to have a requirement list. Then now that requirement list has to be customized, and it has to be very much in detail, so that all the requirements for the audit gets covered, and that can be topped up later, but then it has to be a a standard requirement list or a customized requirement list, which actually gives so all the information, and that has to be documented on the file. So I send an email to XYZ person in the company, and I ask for these requirements, so that is information sought and obtained all the information. So whatever we have sought, we have obtained everything or not. So completeness, you can make a column in the Excel and say pending or received on so and so date, so that becomes a easy tracker also as to what information is there and what is not there, which to the best of his knowledge and belief. So knowledge and belief at that point in time, which were necessary for the purpose of audit, and if not, the details thereof and the effect of such information on the financial statement. So here we are talking about sufficient appropriate audit evidence being available. I have sought, I have got it, I have not got it, and if I have not got it, then I may consider qualification or modification of the auditor's report. Seeking the information is necessary, communication of the requirement list is necessary, status and confirmation of information which is not received, and escalation of the matter to the appropriate authority, and if need be mentioned in the audit report, is mandatory. The next important requirement is whether in his opinion proper books of accounts as required by law have been kept by the company so far as it appears from the examination of those books, and proper returns adequate for the purpose of his audit has been received from the branches that are not been visited by him. So it is actually talking about two things: one about the company as a whole, second is if at all some other person is appointed by to the branch, or if we are only doing the audit of the branch, then whether everything is properly received by us or not received by us. And also proper books of account as required by law. What is proper books of account? Proper books of account is obviously on the basis of mercantile basis, double entry system. Requisite information should be available. All books of account, all relevant information is to be available. If proper books of account is properly maintained or not, that is one thing that we have to cover here. One of the things that I would like to touch upon here, if we are making a qualification in the main audit report, then if there is a say accounting standard qualification, again there are two views that exist. One is they only qualify section 133, but if there is a major impact, and if there is the books of account itself, that is the entry has not been passed, or if as it is amounting to qualification, people do qualify on proper books of account is not maintained by the company. So that is again something that you will have to think of. So writing the audit report, I think, is very crucial, and 143.3, when we look at from the audit from an overall perspective, we end up doing a qualified opinion, we end up doing an EOM in the opinion, but how does those matters, or we end up doing a modified IFC opinion. When we look at those things, how those things actually impact each and every line item of 143.3 is something that will have to be reverse correlated and seen. So we have plain simple sentences, then opinion is completely clean. When EOM is there, it's still simple, there is nothing much to it. When there is a qualification, then each of these matters from A to G has to be actually in detail seen as to whether anything needs a tweaking here or not. So that is something that you will have to pay attention to, because many a times we see inconsistency in reporting. That means there is a inconsistency in the reporting above and inconsistency in the reporting below. So there is a qualification, but 133 is not qualified, books of account is not qualified, so that kind of inconsistency should not exist. In case branch office is audited by someone else, whether we have received all the returns and whether we are satisfied with this. So one of the things that I would like to touch upon here, documentation. Branch, when someone else is auditing the branch, all the things that they have done and all the documents that they have verified, we should be able to obtain it, and then we should be able to make a decision on it. Branch auditor may have qualified the report for certain matters, so it is for me as the consolidated auditor, or it is for me as the if there is component and parent, then it is for me as a parent auditor to consider how much impact it will have on the overall company or on the group, and accordingly decide and discuss in my audit report. And I will have to reconsider whether it will amount to qualification or EOM. For example, if I have a subsidiary and subsidiary has qualified, if I have a standalone report and I have a subsidiary, in standalone report, if I have qualified investments in subsidiary, okay, because of fair value or something, that may not be tenable in the group report, because ultimately the value of the subsidiary gets set off when I come to the group level. There may be an impact in goodwill maybe, but then that will get set off when I come to the group level. So that is how we will have to ascertain and assess as to how it will move in tandem. The next important reporting is whether company's balance sheet and P&L dealt with in the report are in agreement with the books of account and returns. So whether everything is matching is the next thing which we will have to qualify and which we will have to report, which is very much necessary. Okay, so that is something that we will have to always look at and ensure that it is in line. Whether in his opinion financial statements comply with the accounting standards. So accounting standard as defined in 133, it may be Ind AS, it may be normal accounting standards, that is Indian GAAP. So whatever it is, whether it is in compliance with. Now again, I would like to touch upon if there is a qualification with respect to accounting standards in the first section, which is actually affecting the true and fair view, then this portion will have to also be qualified. That is point number one. Second thing, if you are issuing a disclaimer of opinion, all these matters undergo a change. Please remember, if you are issuing a disclaimer of opinion, or if you are issuing adverse opinion, all these matters, none of these matters can be in a positive direction. That means everything will become negative completely and nothing will stay as positive. So that is something that is very necessary to note. The next important thing to be reported on: observation and comments of auditors on financial transactions or matters which have effect on the functioning of the company. Conclusions on matters on the functioning of the company. So this requirement is very typical and this requirement is very much required. So let me elaborate with an example. In the qualification, if there is an adverse opinion, obviously everything is adverse and this will become reverse. If there is a heavy qualification with respect to, say, managerial remuneration, something is being paid extra and AGM approval is not taken, so this may have an adverse impact on the functioning of the company. So that is something that will have to come here. Next example I can think is that if the company is into huge debts and there is restructuring of the company that is happening but it is not yet approved and things like that, and you are qualifying, then it is something that will have to be looked into in detail again. I think there was some internet flicked at my end. Can you please confirm that you can see the screen, because it went off for a minute, I guess.
Yes, we can see your screen.
Yeah, sorry.
Yes, ma'am. You can continue.
Yes. So what do we need to do here? So actually we need to ensure that the issue list is properly populated, the conclusion of matters and the documentation of the matters how we have concluded is very much available in the file. We need to discuss the same with the engagement partner, whoever is the signing partner, engagement partner. These kind of matters also need to be discussed with the management, those charged with governance, and as well as the audit committee. We need to actually keep the entire trail, and then we need to conclude that this is something that is having an adverse impact on the functioning of the company, and then we can qualify there. The next important thing which we all do is that whether any director is disqualified from being appointed as director under 164(2). This is a very known, very old, and earlier 274 1G and now 164(2). So this is a well-known and a old section. So I would not like to go into the sections, but 2-3 nitty-gritties I would like to discuss here. You will have to see whether the director is disqualified. So taking a declaration is one thing, but then taking a step more into going into which are the companies in which he is director and whether they have actually duly filed the annual return, have done all the necessary things, that is something that will have to be seen. In the last 2 years, if you see the MCA portal or if you see the report that is published or some article that I had seen in, I think, Economic Times or something, there are n number of companies who have delayed filing of annual return. So that can disqualify a director. And there is a additional impact if the director gets disqualified, if there is late filing of return, if non-payment of interest, non-payment of deposit, non-transfer of IEPF and things like that, IFC gets triggered. So for those companies, IFC starts getting triggered. So we will have to see that. So the section is very typical. It says that this is the time period within which it can be made good, and after 3 years this can be made good, and within 3 years if not made good, then it amounts to disqualification. So please go through and please read. This has multiple implications, and if director is disqualified in one company, wherever he is director, it will have an impact everywhere. I'm not talking obviously about private limited company, I'm talking about public limited companies. So if he is a director and he gets disqualified, so in all other companies wherever he has directorship, everywhere it gets impacted. So please be careful in evaluating, and as a result of this, something that is very important to remember is your IFC can get triggered. Next important thing, any qualification, reservation or adverse remark relating to the maintenance of accounts and other matters connected therewith. So this is a broader one. When we say books of accounts, when things are matching with the books of accounts, so the inconsistency that we see in reporting is that 1, 2, 3, 4, 5, 6 is correct. Everything is good. There is adverse impact on the company in their functioning, and then qualification on the maintenance of accounts is not there. So I think that mismatch and that consistency will have to be seen. If we are saying that there is a qualification with respect to accounting standards, there is a problem in the maintenance of account, then balance sheet P&L is not matching or anything of that sort, then this clause actually gets reported to. And how do I come to conclusion? Everything starts from the beginning, and then the risk identification and all that process, and then we will have to come to this conclusion. Next, adequate financial control systems in place. We issue a separate IFC report. So there are practices wherein people conclude here in the main report saying that we have opined as per annexure so and so on IFC of the company, and we have given a clean report or a modified report. So they conclude here, but then there is a risk there. Sometimes it so happens that in the main report under 143.3, there is a plain statement which says that we have given a clean opinion on IFC, and in the IFC it is modified. So you have to take care of those cross things also. And then the separate IFC report which we have to provide, we will have to provide. And our responsibilities with respect to IFC is, we all know that you have to have the proper framework. We need to evaluate whether the management has tested it, and then we will have to test it, and then we will have to opine on it. One of the things that I would like to very typically mention here is that there are many reports wherein IFC is qualified, but the qualification is so severe. Now IFC itself gives options that when you qualify the IFC report, if you do substantive testing or other substantive procedures, you can very well mitigate the risk and your main report is still not qualified. But sometimes it is on the structure or it is on the elements of IFC. When it gets qualified, you will have to rethink whether that will actually come and sit into the main report. That means whether it will have an impact on 143.3 or whether it will have an impact on true and fair view of the financial statements. Similarly, when something is qualified with respect to accounting standards, something is qualified with respect to non-maintenance of books of account or something like that, we will have to reverse think whether it will have an impact on the IFC report. So that cross questioning, so I'm not saying that wherever on the main report it is there, it is always there to be in the IFC report, or wherever the IFC report is there, it was also to be qualified in the main report. But one has to think properly as to whether it will impact either ways, and whether it will actually have anything to report in one of these. So because that is most important, and that cross connection will have to be always seen so that we ensure consistency. So the last one is such other matters as prescribed. So other matters are specifically prescribed now. Other matters which are specified under 143.3J. Number one, whether the company has disclosed impact, if any, on pending litigations on its financial position in its financial statement. So pending litigations, where do we look for? We look for the legal and professional expenses. We look for specifically from the contingent liability, and whether if there is any impact, then that has to come and sit here. Typically, one of the things that actually this has a cross connection again with CARO. So the various assessments and other types of litigations that are present there will also have to be evaluated and ensure that if there is anything that is material, then we will have to look into this. So these are matters that will always have to be seen from 360-degree angle, and audit report is obviously holistic view, and then you will have to look at it from overall perspective. The next thing is whether company has made provision as required under law or accounting standard for material foreseeable losses, if any, on long-term contracts, including derivative contracts. So accounting standard, we know that there is a announcement on derivative, and that's how we record for. But in Ind AS we have 109, we have Ind AS 32, and we will have to account for accordingly. So if there is anything that is reportable under this clause, then it has to be very specifically reported, and also the accounting will have to be seen, because that will be a complex accounting. And if there is any non-compliance, then it again goes back to 133 also, and if it is affecting the true and fair view, then to the main upper portion of the main report as well. So these are the things that we will have to actually look into specifically. Next one is very simple, transfer to IEPF funds, and if there is any delay and everything is properly transferred or otherwise. So that's a straightforward simple question, which is a factual reporting, right? So in addition to this, there was another important amendment which is actually coming into effect from from this current financial year, that is year ending 31st March 2022. This is a very wide section or wide reporting that is required. We can backtrace it to section 186 in a way. Few of the things that are required here is 186, layers of the company, ultimate beneficiary, and also the latest schedule 3, wherein the legal and regulatory matters, there's a regulatory section separately, and there are certain things that has to be specifically reported to, and those things are also coming and sitting in the CARO audit report. So I'm not touching upon in this session detailed on every clause of CARO, but however I will touch upon few of the documentation that will be required for CARO when we discuss further on documentation. Auditors report, now the latest reporting as per clause 11E and clause 11F requires that whether management, so number one, it begins with management representation, whether management has represented that to its best knowledge, to the best of its knowledge and belief, other than as disclosed in the notes of accounts. So something that is already disclosed in the notes of accounts, then you need not report here. Other than the notes of account, other than something that is disclosed in the notes of accounts, there are no other funds that are advanced, loaned, invested, either from their fund or from the borrowed fund or from any other sources of fund that they have got by the company to or in any other person or any entity or through an intermediary. And the understanding here can be recorded in writing or verbal, and that intermediary shall that will then they will invest in someone through something, or it is ultimately coming back to the company itself as a beneficiary. So this is actually there to cut down further on money laundering, and this is to actually curtail if there is any root through transaction is happening. So say for example there is company A which actually gives a loan to company B, which is its say associate or a related party. Company B invests in company C, and company C actually gives loan to company D, and then that is offered as a guarantee against something, and which is for which A is actually borrowing or something like that. So that is the trace that you will have to find out, because it is the ultimate beneficiary of routing through of money is A. I understand this is very difficult, and we are put into the shoes of kind of forensic audit, but then these inquiries are very much necessary, and if there is any slightest of the doubts that you have, please ensure that you go into detail, look into all the agreements, get a note from the management, document it properly, and do not leave any open-ended sources here, because this is something that is newly it has come into place, and there is a guidance note also issued by ICI with respect to this as to how to verify this and how to report on this, and it gives various scenarios. So actually even for the reporting you can pick and choose from one of those scenarios. So there is like, company has not given loan, company has given loan, company has given but not received back, and there are multiple scenarios given. Please go through the guidance note and pick the right scenario that chooses that actually suits you, and if that is required, if any tweak is required, then you can make to that reporting as well. The next clause is little bit reverse of it. So it is about the company investing or lending or giving any money, and this is like someone else investing in this company. If someone else is investing in this company by any of these means or any of these things, then also it is actually reportable. And the third main clause talks about whether based on your procedures you believe that the representation that is made is correct or wrong. So if you have any question on the representation itself, that it is wrong or it is misrepresented, then you can state here that company has made a representation, but I don't believe it, or it is not right, or something like that. So that's something that you will have to report. So the points here for consideration, because this is the first time amendment and this is quite heavy, points for consideration is opinion is to be provided on the basis of representation from the management, and also that representation is not materially misstated. So you will have to inquire, and on top of it you will have to if you believe that it is not proper, then you will have to report here. Management has to provide information to the best of its knowledge. So whatever it knows, obviously it has to provide to the best of its knowledge. It requires us as auditor to report whether there are anything that is over and above that is already provided in the notes to accounts. If there are transactions that are provided in the notes to accounts, over and above if something is there. But if nothing is there, then the language can be tweaked accordingly. There is a lot of collate difficulty that you will face in collating the audit evidence, because some of the companies actually said that, oh, this is not applicable to me, I don't do such things. We said no, it has to be reported for everyone. So they were like, no, why should I write something like this? I never do anything of this sort. This looks distorting. We said no, every company that is in the market today will have the same report and everyone will report. And then after they did their inquiries, and then we have to provide the notification, everything, then they said okay, then you can write, but in a if there are no transactions, I have made every representation to you. So there is a pushback from the client also. You will have to educate the client also here. It includes direct, indirect investment also, and wherever and whatever means, right, written mode, non-written mode, whatever it is invested, if you have the slightest of the doubt, please ensure that you inquire properly. It also includes the guarantee and security, and it covers both received as well as lent and invested. And we have to take care of 240 and 315 here in letter and spirit, that is fraud in financial statement as well as risk identification procedures to design our audit procedures. Further reporting is required under clause F, which is very simple. It is dividend declared, paid, and whether everything is properly complied with in accordance with the sections of the Companies Act. So this is a factual reporting thing. A specific non-compliances will have to be brought in, like IBF and things like that. And this includes interim as well as final bonus. And whether it is only out of profit or out of reserve, I think both the type of reserves will get covered here. And this is something that's going to start from the next year, that is the maintenance of the accounting software. So this is being pushed for a year again. So maintenance of accounting software, and whether it has an audit trail facility, I think it is not yet coming to effect, so we will leave it this, and we will discuss that later. So these are the reporting requirements that are very specific on the auditor, and which casts the duty on the auditor. Additionally, there is a section 143. Under section 143 there is another section 12. So section 12 says that during the course of performance of his duty as an auditor, if he has a reason to believe that an offense involving a fraud is being or has been committed, then he has to report it to the central government. So the entire chart is put up, I think okay, the entire chart is there. So somehow it's I think it's not appearing, I'm sorry for that. So basically section 143.12 asks us to report any kind of fraud in case so the procedure goes like this, that as soon as within 3 days, as soon as we discover the fraud, we have to write to the management. And when we write to the management, just a second. So if there is anything that is actually which is believed to be fraud, and if that fraud comes to our notice, then that kind of fraud will have to be reported within 3 days. We will have to communicate it to the management, board of director or board or the audit committee, as the case may be. We will have to receive a written reply. After we get the written reply, we will have to see whether it is actually tenable, non-tenable. If the amount is up to 1 crore, then our reporting responsibility ends when the reporting to the board of directors have been made. However, if it is more than 1 crore, then we have to compile all these documents, our communication, board's communication, why do they believe there is no fraud or there is fraud, or what are the actions taken by them, and our conclusion, everything we will have to send it to the central government, and we will have to file ADT4 there. Now, if the company does not give any reply within 45 days, then we have to make a note and send an email or send a written communication saying that we have not received a reply from you, but we are going ahead and filing this because we have not got any reply from you. So this is a very elaborate process, but everything has to get wrapped up within 60 days. That's the highest trigger. So the moment if you feel that there is a fraud, you have to start working very quickly. If you have to involve lawyers, if you have to take some legal opinion, if you have to consult within the firm, all those procedures will have to be done, and you have to run and rush so that you can close this within time. And anything that is actually which is supposed to be done under 143.12, but if it is not done, we'll go into section 447. Section 447 can have triggers of going into SFIO and triggering a charging the company as well as the auditor with not providing enough information, or which is actually not giving the proper information on time. So what are the requirements? Professional skepticism. So always keep your eyes open, your ears open, and ask the question. Don't accept anything at face value. There has to be a discussion among the engagement team. Risk assessment procedures and related activities has to be very thorough. Inquiries of management and others within the entity is very much mandatory. You have to identify and assess the risk as per SA 315. Evaluate the audit evidence, and then you will have to communicate with TCWG within the time, and then you have to communicate with the regulatory and enforcement authorities. I think that's the responsibility largely as an auditor under Companies Act. I have tried to touch upon documentation when we were discussing all the responsibilities, but briefly just to intermingle the SA 230 plus the documentation requirements of Companies Act. Just put a few slides which can become handy, and maybe we are not going into detail in each of the slides, but then we'll touch upon few of the things. Prime important when we look at audit evidence is sufficient and appropriate audit evidence that we are looking at as per the essays. Each and every essay talks about this. The meaning of audit documentation, we all know there are 3 stages of audit, which is planning, implementation, reporting, which we also call as planning, execution, and completion. And it has to have record of all the audit procedures performed, audit evidence that we obtain, conclusions that we actually reach. And the auditing standards also talk about nature, timing, and extent. So what is the purpose of audit documentation? It helps us in planning. It evidences the entire process of audit, assists in supervision and review and any kind of external review, supports and provides evidence of work performed in compliance with the standards. We have to comply with all the professional standards at all point in time. It supports demonstration in any external or internal review of the audit. External review, we all know, peer review, QRB, FRB, any kind of reviews. Documentation is the only savior. So we have to ensure that we have proper and robust documentation. Form and content, it can be electronic, it can be manual, it can manual in the sense hard copy, or it can be a combination of both. It depends on size and complexity of the entity, nature of the audit procedures, what are the risk of material misstatement that we identified, what are the conclusions that we draw, and what are the audit methodology and tools that we use. Entire audit file is divided into 2 pieces, permanent audit file and current audit file. We all know that permanent audit file is something that will have the master documents like MOA, AOA, laws, by regulations, the appointment formalities, engagement letters, organizational structure, important agreements, few of the management letters, lease deeds, and things like that. And copy of the 5 annual reports and things like that. So that's the permanent file which has to be updated year on year, and that will serve a larger purpose of ensure any new person who is coming into the audit, he can quickly browse through and he can understand. Nature, timing, extent is very important. We have to identify characteristics of specific items and what is the matter under testing. We have to kind of create accountability, and it also facilitates any kinds of investigation of exceptions or inconsistencies. So when we talk about nature means what is the type of test that I am going to do. So whether it will be an analytical review, whether it will be test of control, whether it will be a substantive procedure. So what is the nature of test that I am going to do? Inquiry, observation, detail, verification, whatever we call. Then if we talk about extent of documentation, what is the extent? What is good? Is 100% good? Is 200% good? Is 50% good? It depends on a lot of factors of complexity of engagement, of what are the risks that are involved and things like that. And also timing is like coverage. How much coverage do you have? You have to have coverage of the entire period, and who performed this, and what is the date of completion, and who reviewed it, and what is the date and extent of review, because that is also required as per SP 220, which is quality standards. Few of the do's and don'ts when we talk about documentation, you know, it has to, how it has to be, it has to speak its own story. You don't have to sit beside someone to explain how the documentation is done, because that's not something that is envisaged. It should be self-explanatory. It has to be accountable for its work. It has to be having comparative. It has to be corroborative. It has to be retained records of everything that is of significance, and it should aid the external inspection. What should not be there? Things that are incomplete, highlights here and there, duplicate documents, tens and tens of sets of documents which are reviewed, first copy, second copy, third copy, fifth copy, previous copies of documents that are corrected for typographical errors, other copies, and oral explanations. So I should not be wanting you to sit beside me when I am actually doing a review of documentation. Few of the things that you know, that came to my mind, we can go through very quickly. When we're talking about the planning stage, what is it that is related directly to the Companies Act? Engagement letter, appointment formalities. Appointment formalities, please check the firm number, please check, ensure that proper firm is appointed, please ensure that the year mentioned is correct, NOC is there. All these things are very important. In case of IFC clients, the process notes, flow, understanding, walkthroughs, everything has to be there. Controls have to be properly documented. Details of board of directors, various committees of board of directors, their composition, changes to memorandum of association, articles of association, details of any components which is subsidiary, associate, and all that. Everything, when you gather all these documents, then only you will be able to plan an audit. And all virtual meetings or physical meetings, all the minutes and records you will have to keep. Few of the areas that, you know, while execution of the audit, that you will have to document: access to important information like FAR, inventory records, investments, all these are CARO points. And then statutory records, all the litigations matters, all those CARO points, you will have to have a checklist, and you should ensure that the team is actually properly working on that. Access to all types of secretarial records like minutes, registers, everything that you need. So that is something that you will have to summarize and document. Compliance checklist, please ensure you have a Companies Act checklist, you have a Schedule 3 checklist, you have a standards of auditing checklist, you have accounting standard checklist, Ind AS checklist as applicable, and that will come as a savior always. Verification with respect to, say, specific sections. 185 is something that you will have to have a compliance with it, and then you will have to have a note on it if there are any transactions. 186 compliance, and also the new reporting, the minutes, registers, the supporting of all these things of 185, 186 is something that's very important. Deposits, analysis of the balance sheet. How did you identify deposits, if there are any deposits? And then compliances with respect to schedule, with respect to section 73, that is DPT 3, DPT 1, and all those things. Compliance with 181C limits, any ICD, any other borrowing, external security provided, anything else, then you will have to have the complete listing, and then the security calculation. So these are certain calculations that you will have to do every year, and there is no two ways to it. In case the company has entered into any scheme arrangement during the year, that means any amalgamation, anything that they have done, then entire documentation with respect to that, including the earlier statutory auditor certificate, if any. In case of share capital, any ESOP, share split, issue of shares, bonus, shares, rights shares. So compliance with the Companies Act, compliance with the accounting standard, compliance with the Ind AS is something that you will have to keep very much detailed documentation of. In case of debenture issue, creation of the trust, investment of the liquid amount which is required 20% by the next year, whatever is maturing, creation of DRR, the trust deed, and all those you will have to make a summary, and you will have to document. In terms of execution, further requirements is like, you know, creation of any specific reserves, utilization of the reserves, rationale behind it, if something is drawn from the reserves which are actually not free reserves, and things like that. So all the rationale and documentation. In case of depreciation, schedule 2 compliance, and if there is any deviation, then you need a technical assessment and things like that. In case of a group, you will have to have details of documentation of the components which is subsidiary, associate, JV, and then the related compliances. In case of RPT, you know that there are various levels of approval that it goes through. So identification process, approval process, disclosure process, and how you have identified, you have documented, whether you have seen all the related documents is something that is very necessary to be documented. CSR related documentation, the committee for the CSR, the purpose for which it is spending, whether it is done through the same entity or it is done through a trust, something, and the further details and how it is spent, adjusted, unadjusted amount provided, what is the project, and all the details that you will have to have documentation specifically about. Adequate compliance with other sections like appointment of internal auditor, company secretary, cost auditor, all these things you will have to check because these are part of your CARO. So you will have to ensure that all these things are looked into. In a small snapshot, what are the ROC documents during audit that you will verify? First of all, our own appointment, filing of ADT1, list of director, shareholder in case of company, list of partners, profit sharing ratio in case if there are partners and things like that. And then statutory registers, whatever, 185, 186, 188, everything, all those registers that you will have to look into. Whatever forms are filed by the company with the registrar during the year. So creation of charge, if you look into CARO specifically, this time the creation of charge has also come in there. So that is something that will also have to be looked into very much in detail. Forms filled for the company by the company with respect to appointment, resignation, removal of any kind of key managerial personnel, because all these also can pose audit risk, which we will have, for which you will have to do more work. And any other correspondence with the ROC or any other regulator. So if there is a notice from the ROC, notice from the RBI, notice from IRDA, anything, all those things you will have to ensure that you look into and you ensure that you take into account while you are doing the audit. And in terms of completion of audit, at the final stage of audit, you need to have all kinds of checklists, which is Companies Act checklist, Schedule 3, accounting standard, in auditing standard, everything. And CARO documentation, you need to have a clause-wise checklist, which you will be, you will have to use and ensure that every clause is properly compliant and everything is properly reported. So please do not do the copy paste of CARO from another company or something that is available in the public domain, because most of the clauses may not be applicable to you as well. Compliance with all the aspects of 143.3, which we discussed very much in detail. Managerial remuneration documentation is also required, because that is also one of the things that we report under 143.3. Director's declaration we spoke about, and what are the things to that we have to check about, for disqualification 164.2. Then compliance with the layers of investment, that is in terms of 186, that you will have to look into, and also for the latest rule 11E and 11E 123, you will have to look into. Schedule 3 compliance and all the backup for the requirements therein. As we know, there are 25 to 27 requirements that have been added into Schedule 3 under other regulatory environment. So, the other regulatory requirements. So, backup for each of them, and then also the detailed Schedule 3 checklist is something that you will have to ensure that it is there. Identification of MSME is another important thing, and now identification of stock of companies, that will also has to be ensured that you will have to have adequate documentation with respect to this. And the most important thing, signing of FS, who is signing, because section says who should sign, and minimum number of people who should sign and who all should sign. So you should ensure that the proper people are signing on the financial statements. We have seen financial statements with only one director signing, no MD, no CS, no CFO, no CEO, and things like that. So please be careful as to who is signing the financial statements. Please ensure that that is also provided properly. Management reps, most important, you need to have management rep with letter of representation or management representation with respect to going concern, subsequent event, risking uncertainties, fraud, significant estimate. Also, you have discussed all these matters, and also the latest 11E, the matters that they have not invested, or someone has not invested through the root through scheme or the requisite over there. If at all you are qualifying something, then it has to be discussed with TCWG. If there is something that you're taking as representation, that has to form part of specific representation. So all these things will have to be taken care of very much in detail. Use of electronic signature, we all know that this is very much possible after the COVID scenario. Everyone is using electronic signature. Please ensure electronic signature. So I think one of the basic funda that we all know is that if it is an electronically signed item, both the parties will have to sign it electronically. So one party signing electronically and another party signing manually will not help. So we will have to take care of those things. And ultimately, obviously, since you're issuing the audit report, you have to have documentation about the UDI and also UDI and generation also. Ownership and retention of documentation. Documentation is always the property of the auditor. It is his discretion whether he wants to provide it to someone or no. So you can always retain that. And what is the period of retention? It is 7 days, 7 years from the date of 7 years from the date of audit report. Sorry. Yeah, 7 years from the date of audit report. So that is something that's more important. In case of small entities, the documentation can be less extensive. It can be shorter checklist. It can be, I think, WIRC has provided the checklist publication, I think, few years ago. There is one thing that is also available from forgot the name, but there is another publication also that is available on various checklists and how to document. There are a number of material, Excel sheets and things like that that are available over the web, which can be easily accessed by anyone, and then documentation can be ensured. So I think largely that's it that I wanted to discuss. So open for any kind of questions, any suggestions, anything that we have.
Hello. Yes, ma'am. We have questions. Yeah, we have so few questions are there. We'll just see.
Yeah.
Mishra ji? Hello, Mishra ji.
Yeah. I think I can see the question. Okay, in case of small companies, minute books of the board are not updated on time. How to deal with such a situation? Yeah, I understand this is a common problem that we often face, but then we have to have a definitive end to it. I know that they don't sign it on time and they keep it in Word document or things like that. But then for the purposes of our documentation, you will ask them to, finalize it and give you a scanned copy before the conclusion. And we have to also ensure in such cases that there is no changes that are made. So if we read something as a minutes and then after 5-10 days before the audit closure, if he is signing, then he should not be making any changes. It should be the same document. So either we should ask that through the email he sends all the signed or the extracted PDF copies to us. That is one thing that we will have to insist. One of the things I would like to mention here is that I think it's very necessary for each one of us uh, to continuously educate the client and continuously tell the client that these things are not acceptable. So certain things, when each of us tell them that it is not going to be acceptable, I think slowly and steadily it will have its effect. If we are if I am the one who is accepting it as it is, and if someone else is actually insisting on it, it is never going to work. I think these are some things that are inherent problems which we will have to put our foot down, and then because there is so much of onus on the auditor, I think these are smaller things that we will have to stop obliging or stop kind of saying that it's okay. We have to start saying it's not okay. So I think that is the change that we have to bring in, and we have to ensure that this thing we don't accept easily. It can be board minutes, it can be any other document. You can see it now, I will give it to you later. We will have to have a definitive period for closure of such things, which is very necessary. It is more to safeguard us. For example, the engagement letter, if you look at the SA 210 engagement letter implementation guide, which is come latest, I think it has all the elements which would have been otherwise there in the engagement letter. Earlier, the SA 210 had a illustrative which actually did not have the contractual obligations. Now this implementation guide format has all those contractual format, like limitation of liability, indemnity, and all those. So these are things that actually safeguard us. We should ensure that this engagement letter is something that is prima facie so necessary that we have to enter into in a proper format. And we should define our scope, and we should define our timeline, and ensure that we have those limitation of liability and indemnity clauses also in the engagement, because ultimately audit is also a contract. Audit is also a contract, and if we have a written contract that is signed, it will always be helpful if something goes wrong. If the directors of a private limited company are disqualified due to non-filing of annual return, but the business activities are being carried on, can an auditor continue to conduct the audit and sign the audit report? Yeah, you can do the audit, but then you will have to make a qualification. If they are not doing in a proper manner, then that will affect the true and fair view. But then if they are disqualified but they are running the business, but compliances will have to be done. So under 164(2) you will put that they are disqualified to be directors, and you will have to ensure. But then one of the things you have to see is that if for 3 years this offense continues, then they cannot be appointed as a director, and if they vacate the office, then you will have to see whether that is having an impact on the minimum number of directors in your company. So if it has a cascading effect, then you will have to ensure that you have seen all the angles and then only you are concluding. That will be necessary. If private limited company has not maintained separate list of creditors covered by MSME, how can we identify MSME creditors? If there are any MSME registration number printed on the invoice or any other way. So it is generally it is not printed on the invoice or something, but you know, the onus of identifying the MSME is on the company. So the requirement of disclosure of MSME does not come directly from Schedule 3, but it comes from the MSME Act itself. So MSME Act says that if someone is registered under my act, and if you are dealing with that person, then you will have to ensure that you identify properly, you pay him properly. So the onus of the identification of MSME is on the company itself. If he is unable to identify, you can qualify. Or if he has sent a confirmation, and then if he is comfortable that there are no MSME or there are a certain number of MSMEs whom he has identified, then you should be okay with it. Now this is one of, if I have to say that way, it is one of the control that is built into the RCM by most of the companies. So if they are MSME, then they come to know at that stage. But I can understand in smaller and the private limited companies that is not possible. So they will have to send confirmation. So you will have to ask the client to send out confirmation to all the creditors and to say that when to ask whether they are MSME or not within a certain reasonable period of time. Even if they send out a confirmation asking for, I think if the other party does not reply, then the the ball is in their court, so you can comfortably opine there. Think there is next question. Some directors are holding position in various companies. Trying to check records of each such company can be cumbersome and overrun the cost of the audit. Most pragmatic view would be to rely on the direction of the declaration of the director. To what level an auditor is expected to research should be limited. Okay. So I agree. Largely, we rely on the management representation. I'm not saying otherwise, but you will have to do some more procedure. So these come under unpredictability procedure or additional procedure that you will have to do. Maybe you will not be in a position to check each and every line item. If there are say 15 directors and each of them are directors in 12 more companies, it becomes a large task to do it. But then how I see it is that maybe it has to be, it is a one-time exercise that you will have to done, that will have to be largely put in an effort, and then you can then check on certain moment basis or random basis view of the companies and things like that. So that's how you can actually rely on the representation also, and you can also do some test check basis also, because completely relying on the management representation itself may have its own risks. I'm not saying that everything will be wrong, but then it may have its own risks. What to do if one of the promoters don't give share money? Means I didn't understand the question. Sorry, last one I did not understand the question. Any other questions?
I think so, ma'am, we have over with the questions.
नहीं
Till
मैडम,
now
अभी
we
एक
have.
भी नहीं है।
Mishra ji, do we have some more questions?
नहीं मैडम, हो गया।
Yeah, okay. So, ma'am, I would like to thank you on behalf of WIRC. It was such an enlightening session, and the coverage was extremely wide in such a given time. And yeah, it was such an auditing session. I'm sure everyone who's attended must have been benefited to a great extent. So, thank you so much, ma'am. Thank you for this session.
Thank you so much. Thanks for the opportunity. Thanks to Arpit and entire WRC team. Thank you.
Thank you.
Hi, good evening. Can you hear me?
Yes,
Yes.
yes. Very well.
Yeah.
Hi.
Hello, good
So,
afternoon.
good afternoon, sir.
So hi, Bhavna.
So,
Hi,
yeah.
Sharon. Good afternoon.
Yeah. So,
Afternoon, sir.
so our next
So hi,
speaker, yeah, hi. So our next speaker for the day is Rajdeep Samudrala, sir, and I'm so delighted to welcome him for this session and profoundly. And what I have understood, sir, has been associated with various big fours in all the stat audit teams, and he is presently partner at Haribhakti and Company, and also Sir has secured a AIR 31 in CA final, and so yes, this itself motivates a lot of us, and so brings across 16 years of professional experience in the field of BFSI, manufacturing, real estate, hospitality, and he has also been associated with ICAI for 11 years. He has conducted various seminars and training sessions with WIRC, and also within the firms also he has conducted various sessions uh, in India as well as in London, and also sir has his core areas into IFRS and Ind AS. So sir, I'm inviting you for enlightening us for the today's topic, auditor responsibility for compliance with CSR.
Okay, great. Thank you. Thank you so much, Bhavna. Thanks for the introduction. I'm really glad I'm able to take session today, one of my initial ones with the group, and I'm really grateful for this chance. Thank you so much. Thanks, Bhavna, Suresh, Sharon. So is my screen being shared now? I'll just quickly share screen.
Yes,
Yes, your screen is visible.
Okay. Is it visible?
Yes, sir, it is.
Great. Okay. So great. Welcome everyone for the session. So as it's titled correctly, it's auditor's responsibility for compliance with corporate social responsibility. Now, this session is a very tricky one and a very specific one because it has undergone a lot of changes in the recent past, and the responsibility of not just the company but the auditor also has been enhanced in respect to CSR. So if you guys are aware, the recent CARO amendments has also now put the onus on the auditor for reporting in terms of the CSR discharge of responsibilities by companies. Okay, so let's kickstart. This is my broad content. I'm going to discuss first, introduce what CSR is. I'll explain the entire concept of CSR, definitions, explanation, inclusions, exclusions, and then I will give you all a complete overview of what are the various legal requirements and compliance requirements that are required under the gambit of CSR in the Indian scenario. I will then take you to the last part of this presentation where we'll discuss what are the responsibilities of us as statutory auditors, okay, as statutory auditors in terms of ensuring compliance with the CSR requirements. All right, so let's quickly start. So what's CSR? Obviously, the word stands for corporate social responsibility. So essentially, if you think of it, it's nothing but the responsibility of every corporate in regard to its responsibility towards the society at large, right? 1 minute, I'll just, yeah. Okay, so broadly with your CSR, it has been devised as a regulatory approach. So basically they wanted, I mean, the overall reason why CSR came to place, they wanted companies to not just get from the society, but give back to society. So we wanted to hold the companies as socially responsible entities, not just to shareholders, but to the public and the society at large. So by implementing CSR, we wanted to ensure that the companies become more and more aware and circumspect, as you may say, of its responsibilities, of the consequence of their actions, and what they're giving back to society to enhance the society at large, right? So what is the legal recognition of CSR in our country? I mean, where does it really come from? Because remember, not everything can be enforced unless it is backed by legal act, right? So good news, India was one of the first countries in the world to make CSR a mandatory feature. So what India did way back in 2013, they said that every company is bound to spend money towards CSR activities. Now this became a mandatory feature in 2013, and this is currently governed by two regulations. One is the Companies Act 2013, which has obviously undergone some changes, and more specifically, it is section 135 of the Companies Act. Okay, to support and give additional guidance, they have also issued the company's corporate social responsibility policy rules. So the company's rules issued a year later, 2014, which is nothing but the company's CSR policy rules 2014 supports the way the CSR activities and CSR spend will need to be done by the companies. What is the structure in place? What is the mechanism? What is the policy, procedures, the spending? How much is to be spent? How do they spend it? How do they ensure that the amount that is being spent is spent for the right purpose? It is not going to the pocket of the directors. It is actually going for the benefit of the society, the public. So to ensure that all of that is being done, regulated, implemented, and monitored, they have also enacted the company CSR policy rules 2014. So today let's go through these rules, acts, and policies. Now, to understand CSR in perspective, we need to first understand what exactly are CSR activities. Now, when it was first launched, they were very clear. CSR activity is basically any activity that the company is undertaking in compliance of its obligations under the statute. So here I'm simply talking about all of those requirements under Section 135, the Companies Act, and more importantly, Schedule 7 to the Companies Act. So all of those requirements that Schedule 7 has, let's say eradicating poverty, education, hospitalization, free treatment, removal of unjust causes, hospitals, parks, everything that is expended towards the benefit of the public and the society at large. All of that comes within CSR activities. Clear? So if you want more, there is probably around 80 to 90 items listed under Schedule 7. I won't bore you with that, but remember, these are the activity listed. It's quite a comprehensive list. Basically, it includes everything the company does to advance the benefit of society and public. Now, what the amendment did very smartly and very accurately in the last 1 year, they laid down 6 activities which, even though they appear to be CSR, they will not be regarded as CSR activities. I think it's important to run through this because as an auditor, when we are auditing the CSR expenditure, we need to be aware what qualifies as CSR, but more importantly, what activities do not qualify as CSR. Okay? So let's start. Now, broadly, there are 6 exclusions. Start. The first one, whatever activities the company is undertaking for the normal course of business. whatever the company is doing for its daily operations, that can't be CSR, right? I mean, that is a part of the company's operating activities. So when I call them normal course of business, they become a part of company's daily operating activities. You cannot show them as CSR. But there's one exception, and this one exception is taking in view the COVID impact of 19. So what they said is, if a company is actually already doing something like a CSR, example, they're doing research, development, R&D activities for vaccines, drugs, right? Anything that relates to COVID-19. If this activity is being performed by a company, then that activity expenditure can be included as a CSR, but there's one condition. And the condition is that the company is doing those activities in collaboration with the institutions or organizations under Schedule 7. So basically all those institutes like IIT, the national laboratories, you all be aware of the deductions we get in income tax, right? So those same laboratories, IIT, National Institute, National Laboratory, if the company is doing this activity in collaboration with those listed companies, then that expenditure will qualify for CSR. But if the company is not doing collaboration with them or is doing this as a part of their daily activities, it will be an exclusion under Section 135. Clear? Also, if you're doing collaboration, it's important that the company will list down the activities under the annual CSR report. So are we clear? So be very clear. Understand, what is my client doing? Is my client doing vaccine drugs for COVID-19? Okay, say pharma company. Then are they doing collaboration with the approved authorization, approved institutions? Tick. Are they disclosing? Tick. If these two are covered, it comes under CSR. If this is not covered, it's an exclusion. Clear? Okay. The second, now apart from that, there are 5 other simple exclusions. Basically, exclusions are those activities which are not specifically CSR. Example. So even though you're doing some CSR related activities, if it's performed outside India, it will not be counted. Again, there's one exception. If you are incurring outside India, but for training an Indian sports personnel, then it will not be. For example, if Sanya or Saina Nehwal is training in Hong Kong for a Hong Kong event and she's being trained, and that comes in CSR, because the person outside India and is for the training of the people for representing the country, it will be still included under CSR. Clear? Third, contribution of any amount to political parties. You're already aware, political parties, there are other deductions, other exemptions under the Income Tax Act, and therefore these contributions will not form a feature of CSR. Correct? Fourth, if you are benefiting not the public but your employees of your company directly, example, canteen, welfare, activities, crash services, or any benefit, whatever is for the welfare of staff is not a CSR, it is a company operating expense. Clear? But be careful in this, ensure you understand that apprentices do not get covered under the Employees Act. So if it's for apprentices, you can still claim CSR benefits. Clear? Fifth, any activities that are done by the company on a sponsorship, but again, where the company is deriving marketing benefits. Clear? So again, you'll notice when there's a nexus between the activity and the benefit to the company, it does not qualify as a CSR. So if you ever get confused, guys, just remember one thing. Who is getting the benefit? Is it the public? Is it the society? Is it the company directly, indirectly? So wherever the company is directly, indirectly getting some benefit, it will not qualify as a CSR. So use that as a thumb rule, and then you can go into the specific inclusions and exclusions. Clear? The last one, where an activity is carried out to directly fulfill an obligation under the statute or a law or regulation force. Obviously, right? I mean, you can't say that, oh, I'm doing something for the environment. I'm probably not polluting, or I'm doing some enhancements for the environment credits, and so on. When you're already required to do it as per the laws and regulations, you're doing it as a part of your obligations, you cannot claim CSR expenses benefit. Makes sense? I hope you have the logic behind it, right? Because you're anyway getting a corresponding benefit from that obligation. So you cannot claim a double benefit. Remember, guys, the focus is this act is intended to ensure that you don't get a double benefit. You should just get one benefit once. Is that clear, guys? So let's quickly recap. I have inclusions, which is under Schedule 7, all the eradication party, blah, 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 which is all for the public at large. But 6 exclusions are there, which is activities directly for a normal course of business, except R&D for COVID activities. I have activities outside India, except sports training. I have political party. I have directly benefit employees activities. I have directly getting the marketing benefits activities. And lastly, activities which I'm anyway supposed to do as a part of my obligations. Clear? So you need to be aware, because when you audit CSR expenditure, you are required to ensure that these expenses are directly for the inclusive list of activities and not the exclusive list of activities. Clear? Okay, so now let's go on to the compliance requirements under the Companies Act and the company's policies. Clear? Now what I've done is I've combined the two to give you a holistic knowledge of what are the various regulatory requirements in terms of CSR compliances. All right, let's start the first one. Now, the start of the CSR responsibility is always at the committee level, right? So what they did is, the first step is, let's ensure that every company that is required to do something to CSR will have a CSR committee, right? Now, which are these companies? Important. 3 considerations. 1, if your net worth exceeds 500 crores. 2, if your turnover exceeds 1,000 crores. Or 3, if your net profit exceeds 5 crores. Now remember, it's very straightforward. It's like 1, 2, 3, net worth, turnover, revenue, and profit. If any of these 3 are crossing any threshold in any financial year, then you are required to immediately kickstart and form a CSR committee. Now, mind you, it is any financial year. So the moment you exceed it, you are obliged to constitute a committee. Now, the committee, obviously, it will be a subset board, right? It'll have some members. The committee should have 3 or more directors. Obviously, the directors will be reporting back to a board. Now, these directors should also include 1 independent director. Clear? So, I have a committee in place who will have 3 directors and 1 independent. So, you will need to make sure that this committee is in place with the required level of quorum and directors. Now, this disclosure of this committee is required. You need to disclose what a composition, how many people, how many directors, what's the qualification, what's the age, and so on. What does this committee really do? The committee will formulate an action plan of how much to spend, where to spend, which activities, which policies, which areas. It will formulate an action plan. It will also recommend how much amount is to spend for what activities. Example, the committee says, let's spend 10 crores on CSR. For which areas? Let's say 1 crore for creating a public park, 5 crores for opening a school in a backward area, 2 crores for some programs relating to eradication of poverty, 1 crore for opening a hospital. So the committee will approve a proper action plan and recommend to the board what CSR activities should take place for that year. Is that clear? Okay. Now, there's a slight exemption or relaxation, because many times not every company can afford a committee. So there's a relaxation that if the amount that the company needs to spend is less than 50 lakhs, the requirement to form a committee is not needed. So basically, there's no need to sit and form and appoint directors of a CSR committee. But that does not discharge the responsibility of the company. So if the committee is not needed, the company chooses not to form a committee, the board of directors will be given the responsibilities of the committee. Clear? Okay, so let's quickly recap what the functions were. Yeah, what the functions were. The committee will tell the board, this is what I need to spend on these activities, so much money, so much activities, so much amount, and the committee will also be monitoring the policy from time to time. So basically, everything to do with inclusions, exclusions, activities, expenditure will come from the committee. And the committee will take care of the implementation part. What does the board do? Obviously, the board will ensure that what the committee is doing is in accordance with the compliance requirements. So when the committee that was formed in the earlier step recommends to the board the policies and the expenses, the board will approve this policy and ensure that all the contents, the policies, the procedures, the steps, the committee, the requirements, all of that is approved and disclosed and placed on the company's website. Clear? Now, apart from that, the board has one more very important responsibility. It will ensure that whatever activities the committee has proposed or has included in the CSR, all of those activities are actually included or allowed, and they're actually performed by the company, right? So it's very important that you don't just put a policy in place. There should be a proper execution, a proper implementation of the policies, of the activities, of the requirements. Now, a very interesting amendment took place where the onus to invest and do the CSR activities is not on the company alone. The company can also do it through the other entity. So the company can appoint another entity who will perform or invest in the CSR activity. But mind you, this other entity must be an eligible entity which is registered as central government and which has effectively filled up the relevant form in form CSR 1, and then it can do the work, right? So the company can say, okay, there's some activities, either I do it or the other eligible entity does it. Which are the entities quickly? Let's get it. It is from rules, under rules of Rule 4. Any company that's Islam, Section 8 of the Act, Section 12A, ATG, basically all these charitable institutions, NGOs, all these registered trusts, registered societies, these trusts or societies or NGOs or other entities that are empowered by the central government and given the registration under the Income Tax Act, these Income Tax Act registered trust and companies which are established under the Parliament Act will have the eligibility to do the CSR activities. So basically, when a company gives it to another entity, it is their responsibility and also our responsibility as an auditor to ensure that these entities are eligible entities. Clear? Okay. Third, it does not end there. A very important onus has been given to the board where the board needs to not only satisfy, the board should satisfy that the money given to the entity has been utilized, but the board through its CFO should certify that the money disbursed has been used for the purposes and in the manner approved by the board. So it's many as possible, right? That the board has given, let's say, 5 crore rupees to another entity and said use it for CSR as per the rules, policies. But how do you know? I mean, if tomorrow the company can't say I gave it to them and they have used it or not used it, they cannot claim ignorance of that. So here, this third point, very important, the company's board should satisfy that the funds have been disbursed have been utilized for the purposes as approved, and the CFO signs off to it. So it's a very important point here, because tomorrow, if for some reason some money is not got, the CFO certification could be false. Clear? So this is a key point of the board's responsibility. Now let's come to how much is we spend. 2%, 5%, 3%, what? So the magic number, as per the section 135.5, is every board should ensure that 2% of the average net profits of the company during the immediately preceding years. 2%. So I'm looking at whatever profit the company has made. Let's say it's made 10 crores, 5 crores, and maybe another 3 crores. So 10, 5, 3, 18 years divided by 3 is 6 crores. So the company will spend 2% of the average 18 crores, which is 6, 2% of 6 crores, which is probably 0.12. Clear? Now remember here, we're looking at the last 3 years, but what if the company has not completed 3 years? Then what? That's fine. Do it from the date of incorporation to the immediately preceding financial year. Now here remember, the amount to be computed is based on the immediately preceding financial year. So if I'm looking at 22-23, right, I'm in this year, if I need to decide how much money is to be spent in 2022-23, I will look at the profits of the last 3 financial years, obviously the audit numbers, correct? So 19-20, 2021, 2022. And if the company is incorporated in 21, say March 21, July, then I'll probably look at, 20 July, so I'll look at July 20 to March 21, April 21 to March 22. So that's fine, that's an exemption. Is that clear? So 2%. Now, when you say 2% of the net profits, what net profit am I looking at? Obviously simple, right? The net profits that is shown in your income statement. But remember, not just any income statement, it should be the income statement that you prepared as per the act, the relevant act. Right? This is basically to cover every type of company. Banking company will cover the Banking Regulation Act, insurance under the Insurance Act, other company under the Companies Act. So as per the provisions of every relevant act. Right? Now here, 2 things are to be specifically excluded. You'll not include these. What? Any profit that is arising from the overseas branches of the company. So any overseas branch of company which is coming from there, now whether it's a separate company or not, if it's coming from, let's say, an American branch, let's say Kotak Bank is an American branch, or Yes Bank has another branch in Dubai, the money is coming here, that profits will not be included. And second, what comes from profits? Dividend. Any dividend received from other companies in India which are covered under and comply with section 135. So any other company that's paying dividend to you, now that company, remember, is already paying dividend after providing expenditures and after providing for CSR. So if that company is already paying CSR and then paying you a dividend, that dividend amount is to be excluded, right? Obviously, because again it becomes a double counting. Why to double charge it? So exclude that. Excluding profits of overseas branches and excluding profits of dividend. After excluding these 2, all other net profits as per the Companies Act, as per relevant act, in accordance with the presentation disclosure requirements, will be considered for 2% for CSR expenditure. Clear? Now, a very unique point here to ensure that I am spending only for CSR and not for other ongoing admin expenses, right? So what has come by the amendments is the board of the company will ensure that when you have a CSR expenditure, you're not spending more than 5% of the total expenses for administrative expenses. the amount should go completely for CSR. Basically, decisions, implementing, designing, monitoring, overseeing, evaluation, proper CSR, all of this comes within my CSR. If I'm allocating 10 crores, I should make sure that more or less 10 crores is actually expended for the CSR activity. Obviously, the small exemption 5%. So out of 10 crores, let's say half a crore, 50 lakhs you can spend for general administration of the CSR function, but you can't spend more than 50 lakhs out of 10 crores for administration functions. Obviously, the objective again is to make sure that when you are allocating money for CSR, it is going for the productive CSR and not for other non-productive activities. Clear, guys? Okay, so look out for this. Ensure the company is not playing, playing naughty with their CSR and trying to show other non-productive and chalo bhi CSR mein dal diye. You cannot exceed 5%. Clear? And that's the rules under the CSR rules. Now, a new amendment, a very interesting one, came up where we said that while you're spending for a CSR project, right? This is an important part of our compliances. Companies which are undertaking a CSR project, which are a multi-year project or 2-year project. Let's say I'm building a hospital, right, for the needy. My company is allocating 10 crores for that. Now, if this concerned hospital, you obviously know, right, a hospital can't be completed within a year or 6 months. So if I have a timeline, which is potentially 2.5 years or 3 years, not exceeding 3 years, then this becomes classified as a multi-year project. And this multi-year project will come under the definition of an ongoing project. Clear? Now, why is it important to classify ongoing project? Because in this case, the company can spend the money for this project over the period of 3 years. Over the 3 years. Now, obviously, let's say I told you I want to put aside 10 crores for an hospital. Now, the hospital will probably take 2.5 years to be completed. So if I spend, let's say, 4 crores this year, the remaining 6 crores, which is yet to be spent for the hospital, will be kept aside in a separate bank account. And I will use that 6 crores over the next 2 years. Now, this provision was not there in the earlier rules. In the earlier rules, you had to spend the money. If you don't spend, you transfer to a fund. But here, the Companies Act is giving you the option to keep aside the entire 10 crores for a 3-year project. And whatever you spend, you can spend it. The unspent amount, you don't have to transfer to a fund. You can keep it in a separate unspent account and utilize it from that account. But mind you, there's a requirement to ensure that you keep it in a separate bank account that is aligned. You can say lien. It's only for this purpose. You cannot, you should probably put a caveat that that bank account is only for this hospital. You can't use it for other purposes. In that case, you will monitor the project and ensure that's completed over the 3 years. Is that clear? Now, regarding ongoing projects, what will the board do? The board will monitor the project's implementation every year and will ensure that whatever changes are to be made will be made within the overall limit. So suppose, let's say I have 10 crores, I put aside. The board will ensure that 10 crores is spent on an ongoing manner, and every year, whatever money is still unspent, it will be transferred to a separate unspent CSR account. Is that clear? You guys will often face this as a part of your audit, where the client will say, boss, ye paisa to kharch nahi kiya. What to do? Transfer it. Don't keep it in your bank account. Don't keep it in your ongoing operating bank account. Keep it in a separate unspent CSR account. And monitor, review, evaluate, check, keep checking that the amount is being spent only towards that purpose. Clear? Now, let's get to a very interesting part of it. Any surpluses, okay? Now, obviously, It could so happen that you have done some CSR activity and you earn some surplus out of it, right? Example, you opened a school. The client opened a school for the poor children, the needy children, right? And maybe they've taken some nominal charges towards lunch, or maybe for activities, or maybe admission. It's meant to be free of cost, but some nominal fees. Now, whatever income they may earn from the school, or from the running of the school, or whatever sale they took, whatever income they earn is a surplus. That surplus cannot be plowed back to the profits of the company. You can't say CSR पे profit बना और वो company का profit. No, the profits or earnings or surplus from a CSR activity have to be reinvested, have to be plowed back into that same CSR activity. So if you spend 10 crores, let's say on a school, and you earned 10 lakhs or 20 lakhs from admissions or donations or something from that school, that 20 lakhs will be reinvested into the school's activity. And if you do not, then transfer it to an unspent CSR account. Is that clear? If you do not use that unspent amount within a period of as 3 years or the time period, then you are required to transfer that surplus as per schedule. Is that clear? So it's important that either you use the surplus for the activity, or you transfer it to the unspent surplus account, or you transfer it to the fund of the government, which is for CSR. Is that clear? Now, there are certain timelines, and you have to, as an auditor, you are required to ensure that these timelines, if they are not met, if they are violated, our audit report under CARO will require a disclosure of such non-compliance. So guys, very important that we as auditors are not just aware of what CSR spending they're doing. We need to be also aware of what non-compliances took place in accordance with the Companies Act. Is that clear? Right? So check with the client with any income earned from the school. Okay, earned. What do you do with it? Did you put it back? Did you take it in your profit and loss account? Did you show other income? You can't do that. You take it to unspent CSR, you're supposed to give the money back to the project. Clear? This is a little rare one. This is something you don't really look out for. So as auditors, our job becomes more difficult, right? You have to start auditing not just the income from operating point of view. We should look out for any receipt which is not pertaining to company, but which is out of a CSR activity. Clear? Now, let's come to, I've been talking a lot about unspent CSR. Now, what is exactly unspent? So the special unspent CSR account is nothing but a bank account. A bank account that a company is required to open with any scheduled bank. I need to open the account and I need to show it as an unspent account. Is that clear? So this special bank account, which is the unspent account, is to be maintained for all the money that has not yet been spent for CSR work. Is that clear? So anything which you do as a part of your policies would go into account. Now there's a deadline here. The deadline. You have to transfer all the money within 30 days of the financial year. Now, mind you, if it's an ongoing project, then only you're allowed to put the money in an unspent CSR account. If it's not an ongoing project, guys, be careful. If it's expenses for an activity which is for the year, not ongoing, then there's no such concept as unspent CSR account. Then you have to simply transfer money to the fund of the government. They'll take care of it. So let's understand carefully. If it's an ongoing project, 2 to 3 years, you can transfer the money, unspent account, and keep spending it for that project over 3 years. If it's money that is not yet spent on a project that's one time, then you can't put it on unspent account. You will transfer it to the fund of the government. Is that clear? Okay, now let's come back to ongoing. You have an ongoing project, you put in unspent CSR. What will you do with the amount? You will spend the amount over the life of the project in pursuance of your CSR obligation within 3 years. If after 3 years you still have some money left in that unspent CSR account, you still have some money left which is not spent, then you are obligated to transfer the amount to a fund of the government. And that fund, which is within 30 days. So within 3rd year, transfer all the money to the government fund. Are we clear, guys? So this requirement is important for you to understand, because this is one of the requirements that you will be auditing, that you will be signing off in your audit report under the CARO report 2020. Clear, guys? So very important requirement. Please ensure that you are up to speed with this requirement. Okay, another additional rule, impact assessment. Now this is entirely from a company requirement point of view, nothing too much from an audit point of view, but be aware of it. If a company has a CSR obligation which is like over 10 crores, okay, in the last 3 years, then in addition to a CSR expenditure, the company is also required to undertake an assessment of the impact. We call it impact assessment. This assessment will be done through an agency which is independent, and this agency will basically look at the impact of all their projects where they have spent 1 crore or more. Clear? So the agency will come and say, okay, fine, this is spent 1.5 crores ticket. They'll do a proper impact assessment of all the projects where 8 crore ke upar, 1 crore or more, they have spent the money, and also which have completed, which have been completed not less than 1 year before. So they will take only those projects in the last 1 year. Is that clear? Okay, now this is required only for the large CSR spendings, 1 crore. And this report is required to be placed before the board. All right, the board will look at the report, and this report will then be assessed and considered accordingly. Clear? A company undertaking impacts may also book the expenditure. So whatever they've spent, they'll book as CSR. So are we clear? Impact, this is also a new rule which has come across to ensure that company are not just spending, but they're also trying to assess what is the broad impact of the expenditure. Are we really impacting the public? Are we benefiting someone's life? Are we making a difference to society, to public at large? Clear? Now all of this is CSR expenditure, but what about the reporting requirements? Simple. The company will boast, I have done this. The company has the right to boast. They will boast about all their CSR activities, hospital, orphanage, buildings, trust, in the board report. In the board report, which will be covered as a part of the annual report. Right? So board report will contain an entire section on the CSR report as per annexure 1 or 2. Okay, if it's a domestic company, this is a requirement. If it's a foreign company, then the company will have to publish. They'll give a balance sheet file under the section 38(1). They will contain an annual report on the CSR activities. Whichever it has for annexure 1 and annexure 2, they will contain a list of all the CSR activities that have been performed, executed, ongoing, completed, spent. The company will give the detailed report. Apart from this, a company needs to also disclose all the CSR activities on the website of the company. So if you open the website of any company, you'll see they'll have the list of all the activities, CSR policies, the CSR committee, how many directors, 1, 2, 3 directors, the names, the projects, the expenses. It will give all those reports on the website for public access, right? So basically it's a requirement that you don't just spend the money, you also give a disclosure on your website. So 2 disclosures, website and your board's report, a part of the annual report. Clear? Now, if you do not comply with all these requirements, what do? Penalty. Now, this is again an important aspect from an audit point of view, because we need to make sure that we are covering the possibility of non-compliances along with a possibility of a payment of penalty. Now let's look at the penalty clause. As per the CSR compliances, the company is liable for a payment of a penalty that's 2 times of the amount required to be transferred. So if the company was supposed to transfer unspent amount of say 1.5 crores, fund को transfer करना भूल गया, so or it didn't transfer as per timelines, the company will pay a penalty of 2 times 1.5 crores, so 3 crores will be paid to the fund. But there's a limitation. They have capped it at 1 crore. So if your penalty exceeds 1 crore, then you're required to pay only 1 crore. So twice the amount that you have not transferred, or 1 crore, whichever is less. Now, apart from the company, which is all the directors and all, every other officer who is guilty, who is in default under the Act, will also be liable for a penalty of 1/10 of the amount that was required to be transferred. Again, the limit is capped at 2 lakhs. So if 20 lakhs, if suppose 10 lakhs was supposed to be transferred, I'll be charged 1/10, which is 1 lakh, or the upper limit is 2 lakhs. Again, whichever less. Is that clear? So guys, there are twofold penalty here. One is a penalty on the company, where 1 crore is the maximum limit, and a penalty on the person responsible, where the limit is 2 lakhs. Is that clear? So as an auditor, be careful. We also have to make sure we understand that if there is a non-compliance, then the amount of penalty that is possible on account of this compliance will have to be factored as a part of my audit adjustments. I hope you're aware of that. So suppose you feel the client has to pay a penalty of say 30 lakhs and your materiality is only 15 or 20 lakhs. The penalty is more than your materiality, so there's a possibility of a material misstatement if the client does not provide for it. So be careful. This is the limit to which we need to assess our true and fair view. Clear? So always adjudge if there's a penalty, how much the penalty could be, what is the possibility, what is the probability, what is the measurement of the amount, and try to get the client to provide for it, or it may result in a qualification or emphasis matter or a misstatement. Clear? Right. So now that you understood what is CSR, what are CSR requirements, compliances, let's quickly look simple 3 slides on what are our responsibilities. Now remember, to know our responsibility, you have to also know what I've discussed so far in terms of compliance. As an auditor, we have 7-fold responsibilities. If the company is undertaking the CSR themselves, not going to another agency, then we have to make sure we take care of these 7 things. What are they? 1, whatever activity a company is doing, we as an auditor need to ensure that this activity is within the purview of Schedule 7. Simple. Is it for the eradication of poverty, unemployment, hospital? Is it for the public safety? Is it for the public at large? So look at Schedule 7 and make sure it falls within one of those 13 requirements. Simple. Second, if you have not spent it, but if you have contribution or donation, then ensure that that donation contribution is also for Schedule 7 activities. Simple. So activity project, Schedule 7. Donation, Schedule 7. Third, ensure that the disclosure as per Schedule 3 on the CSR Act. So make sure the company is making a relevant disclosure for all the CSR spending. That's a part of your audit. Fourth, ensure that the money spent for CSR is in accordance with the CSR policy. So obviously you're making sure that जो भी खर्चा, जो भी expenses हो रहा है, whatever CSR spending, it is meeting the guidelines of the CSR policy rules. Clear? Basically, it is only for the CSR activities and in line with the CSR policies. Fifth, now this is a little tricky one, but it's a little important. Ensure that the company has complied with the recognition, accounting, disclosure, presentation, measurement. So what are the standards in terms of say expenditure accounting, revenue recognition, capital revenue, all those requirements under the standards that you already are aware of, that you already are complying with. Ensure that those requirements are also being complied with in regard to accounting standards. So accounting standard, expenditure measurement, timing, recognition, all of that should be as per AS or Ind AS if it's under India or other gaps. Clear? Sixth, apart from accounting, you need to ensure you're ticking off the requirements of the standards of auditing. Now here there are two specific standards I want to highlight. Standards on auditing on 250, which is laws and regulations. Now you already know from the discussion so far, CSR is driven by Companies Act and company CSR policy rules. So you need to ensure that the compliances with CSR rules and regulations in India are being followed. SA 250. Apart from that, there's SA 720, which is other information. You know that the board report, the annual report will contain a lot of discussion around CSR. As long as the discussion is in line, it's consistent with the other information that's being disclosed, then you have complied with your responsibilities. So ensure that all of the information that is being discussed in other parts of the annual report is in line with the main report, the notes, the financial statement, and so on. Is that clear? So these two are a part of auditors' responsibilities, SA 250, SA 7. And last, not the least, ensure that you complied with the guidance note on audit expense. Why? Because we are auditing expenses, right? So you're making sure that whatever expenses you're auditing is in line with the CSR expenditures threshold, comply with the guidance note, and you have discharged your responsibilities. So these are, you can probably note this down. These are your 7 checklist items from an auditor's responsibility point of view. Now, what if the company has undertaken it through another entity? खुद ने नहीं किया, किसी और ने किया. Simple. My responsibilities are limited. If that is the case, then you have to only do one thing. Obtain the auditor's report from the other entity. Tell the entity that you're auditing to obtain an independent practitioner or auditor's report on the expenses incurred by that other entity. Simple. That's all you have to do, which will effectively discharge. But also in this case, what will the auditor of the other entity do? He is required to do 3 things. Okay, so let's recap. As an auditor of my entity, I'll say, boss, you spent through that, so I want their report. Now, their entity report will do 3 things. 1, will ensure that that entity has spent the money on CSR as per Schedule 7. That's his job. Clear? So he'll ensure that's all done as per Schedule 7 and Section 135. He'll also ensure that the expenditure is verified and audited as per the guidance note. And third, he will ensure that the funds have been utilized in accordance with the guidance note on the reports or certificates. Because remember, he's giving you a certificate or a report, so he has to ensure that all those report requirements are being met. Now, why is it important? Because suppose, let's say you guys as an auditor are asked to give a report on your entity, which is an eligible entity. Then you need to make sure that you verify the funds, the expenditure, the guidance note, and the utilization of the CSR funds. You will ensure you tick off these boxes before issuing a report for your eligible entity. Are we clear? So this is a scenario where there are 2 entities. One is the main company and one is the other eligible entity, right? And the last reporting requirement of an auditor under Companies Act is CARO. Under CARO, every auditor is required to give 2 responsibilities. 1, for ongoing projects, the auditor is required to give an opinion and a statement whether the company has transferred all the unspent amount to a fund within 6 months of the expiry of financial year. Now, this is for those projects which are not ongoing. Remember I told you, if it's a 6 months or a within 1 year project, other ongoing, then you cannot claim unspent. You have to transfer to government. You can't put in unspent account. So if it is not an ongoing project, the auditor, as an auditor, you will certify whether the company has transferred the unspent amount to a fund or not. Simple. Not transferred, then they'll pay penalty. But here the time gap is 6 months. The second requirement, and this requirement comes from the point of view of the ongoing project. Here we'll say that any amount for an ongoing project which is not yet spent, you will certify if this has been transferred to a special unspent CSR account within 30 days. Clear? Now, what happens after 3 years is not defined as of now. I guess it will come in the next 2 years, because right now we are still in a 3-year period, right? So now your job is only to check कि जो भी पैसा is still unspent, whatever is still unspent for an ongoing project, has it been transferred to an unspent CSR account? Yes or not? Not transferred, not spent, transferred. Is that clear? So that's the only requirement. There is no requirement of a fund. Clear? So ongoing, not ongoing. If it's ongoing, unspent account. If it's not ongoing, has to go to the government's fund within 6 months. Is that clear? This concludes our audit responsibilities. So quickly recap, I discussed what is CSR, what's the mere CFR, what are compliances under section 135 and company's CSR policy requirements, and I concluded with the auditor's responsibilities on the CSR. Thank you, guys. Is there any questions? I can take that up. Move on to the next person. Yeah, hi, Suresh.
Hello, sir. Just a second, I'm just checking the questions log. So we have 2 questions.
Yeah.
One is the criteria of net profit of 5 crores for coverage is for the current financial year, or it is the average of net profit of earlier financial years?
Okay, so as I highlighted, guys, and be aware of this, it is obviously it can't be current year, right? Because you are going to start the next year based on the prior years. So the criteria is only the preceding financial years. So if I'm doing 22-23 CSR spend, I will look at 21-22, 2021, and 29-19. Clear? So it is the preceding financial years, not the future or the current financial years. It's the actual figures.
Thank you so much, sir. The second and last question is, which other officers will be identified as guilty of non-compliance of CSR spending apart from directors? Are there any defined person for the same in the act?
Very good point. So this is actually subjective. I was looking for additional guidance, but normally when you say which other officers, so this will essentially mean the officers who are a part of your CSR committee, the directors who are in charge of the CSR funding, and potentially the officers who have been appointed and approved by the CSR committee and the board to drive the CSR spending. So I think essentially in this case it will be the board and the CSR committee members and any authorized appointed officers appointed by the CSR committee directly. We will not hold the CEO or the CEO responsible who are probably not a part of the board. They will not be. It will be only those who are authorized in this regard, specifically by the company.
Okay, so I guess this answers the question. And we have one more question, sir. The 2% which you said is of net profit. Is it PBT or PAT?
No, it'll be PAT. It'll be net income. Potentially be net income because government says, boss, mera paisa pehle do, fir uske. So it'll be the net income as was defined is after tax. First pay the tax, then pay the CSR.
Definitely.
I was expecting a question, but because not come, I'll still answer it. Some people often wonder, yaar, agar loss hai to kya karenge? If there's a loss in 1 year, so I'd like to answer this because this is a problem area I've seen as a quality research question. If there is a loss, then the consensus is you try to ignore the losses and take only profits. This is a conservative view. So suppose I have profit of 10 crores, loss of 5 crores, and a profit of 7 crores. I'll ignore 5, I'll take 10 and 7, 17. But you may not be wrong to consider losses also, because they just say net profits. But I would say conservatively try to ignore the losses and take only the profit figures from the last 3 years. If there's no profits, then ignore it. There's no CSR obligation. Clear?
I guess we have got one more question. A company has donated respect of CSR to a trust approved by government on 25th March 2022. How do we check for the amount spent by the trust?
So again, see here, frankly, you know, to check the amount spent in trust. So we have to simply do one thing: ask for the auditor of the trust to give the statement. Simple. And it is the headache of that auditor to give the report on what the trust has spent. Having said that, it's a very practical thing. In 8 days, in 5 days, really nothing much can be spent. But the trust can probably tell us that we intend to spend on something and give the compliance. So that is the headache of the auditor of the other trust. And they'll give the report. See, remember, to the extent you can verify. If you can't verify, guys, ensure that you take a sufficient, suitable audit report from the auditor of the other entity, so that you are not, you are not being caught in something that cannot be verified. Clear? Excellent. Great,
sir. Thank you so much, sir. I guess this is all questions we have. Thank you, Rajdeep sir, for such an insightful session. I guess now, since what and why both are clear, I guess it will be, definitely help all our fellow members in further understanding the compliance with respect to CSR. Thank you so much, sir, for your time.
Great. Thank you, Suyesh. Thanks for calling. Bye-bye. Thanks, everyone. All the best.
So our next topic for the day and the last topic for today's session is again very interesting and a very important topic, as it talks about the powers, duties and responsibilities of an independent director. The role of an independent director in today's time is way more than perceived. To enlighten us on the same, we have CA Prateek Khandelwal sir, who is the partner of BDO India, and he's having a vast experience of more than a decade. Prateek sir, I invite you to take it further.
Hi Suresh, am I visible and audible?
Yes, sir, now you are visible and audible.
Okay. So I share my screen.
It's not visible. Yes, it's now visible.
Okay, thank you. Show my screen. Is my screen visible, Suresh? If you can confirm.
Yes, it is. Yes,
okay,
it is.
Thank you. Pronouns and getting some issues. So, very good evening to all the attendees, and thanks to WIRC to giving me this opportunity to present on a very important topic, like Suyesh mentioned, and it has more relevance in today's world when auditors are shouldered with so many additional responsibilities. So the responsibilities which comes from the governance body of the company is equally important. So in the interest of time, I just start quickly that in a company, the governing body, the board of directors, represented by many directors, which includes additional director, managing director, nominee directors, independent directors, etc., women directors, which is now more relevant after having this Companies Act 2013 in place. The one of the important aspect that what is the roles and the responsibilities of an independent director, because the name itself indicates the independent means their opinion is unbiased and they are impartial, and therefore their decision making reflects the trueness in the functioning and the governing body of the company. Independent director is required to be appointed by every listed company and public companies which has a paid up capital of more than 10 crore or turnover of more than 100 crore or borrowings more than 50 crore basis the latest audited financials. Now, important to understand what are the regulatory aspects in place which defines the independent auditors, which defines their roles and responsibilities, their appointments, their qualifications, etc. The prime regulation, the prime act is Companies Act 2013. If we compare Companies Act 1956 versus Companies Act 2013, the Companies Act 2013 has defined independent auditors' roles and responsibilities substantially, significantly, and enhanced their presence in the companies to make sure that the governing bodies work as per the expectation of the regulator and meet the expectation of the stakeholders and other shareholders, especially the minority shareholders. So there is a chapter 11 which is specifically dedicated to the appointment and qualification of directors. Section 149 of that chapter deals with independent director. We'll see in upcoming session. There's a specific schedule, Schedule 4, independent directors of the Companies Act 2013, which defines responsibilities, roles and functioning, meetings, manner of appointment, evaluation, etc. for an independent director that we will discuss in detail in upcoming slides. Further, the Companies Act has given a detailed rules on appointment and qualification of directors to make sure that the provision given in section 149 and in chapter 11, not only 149, in chapter 11 are complied with. Since the listed entities are regulated with SEBI also, the SEBI also defines various provisions under SEBI LODR regulation for independent directors. Similarly, the Reserve Bank of India, which is a regulator for lending institutions, especially banks, NBFCs, housing finance companies, defines the requirement of independent directors in the governing bodies and various committees of the board of directors in the company, which is more relevant to the banks, NBFCs, and housing finance companies. However, the appointment, qualification, eligibility, roles and responsibilities is primarily defined under the Companies Act and governs from there. SEBI and RBI just only define the composition but does not define the responsibilities. However, these directions set back to Companies Act to make sure that the roles and responsibilities are adhered. So as I mentioned, the Companies Act defines section 247 of the Companies Act. This says for independent directors, we need to refer section 149. Under section 149 subsection 6, what is the definition of an independent director? I again reiterate myself, the word itself says independent. So just to understand what a person can be an independent when he is not related. So a person who is not a director, who is not a managing director, nominee director, or a whole-time director, who has expertise, experience, specific set of skills and knowledge, who is not directly or indirectly related to the company or the group in which the company operates, means not related to the holding, subsidiary, or associate of the company. The person or his relatives are not directly or indirectly linked to the company or the group in which the company operates. He has never served a position of an employee or as a key managerial person of that company or the group in which that company operates. The definition extends beyond that and says that the person has not served to the company, being a consultant, an auditor's firm, a law firm, a legal firm, or has not been an employee in past, does not hold more than 2% of the voting power in that company or in any of the group companies, and also he is not holding any position in the non-profit organization in which the company contributes 25% of their total receipts. So in a nutshell, a person should be an independent from all the aspects, and this definition is defined very practically considering various scenarios and events and faulty events that we have seen in the various companies. So that's if person meets all these criteria, becomes eligible to get an independent director in a company. But what is the qualification defined? The qualification is defined for an independent director under Rules 2014 for appointment and qualification of a director, which says an independent director shall possess an appropriate set of skill, knowledge, or expertise in the field of finance, law, administration, marketing, research, technicals, corporate governance, or any other disciplines, which is relevant to the company business in which that appointment is proposed. If a person meets this criteria, becomes eligible and qualified to get the independent director's position. Manner of appointment. The manner of appointment further defines under the Companies Act, under Chapter 11, provided with the rules, and Schedule 4, which says that a person shall be appointed as an, so we discussed who could be an independent director, we discussed what could be the qualification. Board of the company will define and will identify a person as an independent director, will make sure that person has a set skills, knowledge, and experience relevant to the company, and it would be a balanced position in the board composition. So what is the balanced position in the board composition? We will look in upcoming slides, because most of like SEBI, Companies Act, RBI defines that what could be the composition, and in that composition what could be the number of independent directors. So that needs to be taken care of by board, and to make sure at the same time that that person is an independent to the management, because independence is a key. Like for an auditor, independence is a key. Such appointment shall be approved in the general meeting of the company. While convening the general meeting, a notice shall be attached which will explain the set skills and experience of a person proposed to be appointed as an independent director, and confirming that such appointment is in line with, is in accordance with the act, and the person proposed to be appointed is independent to the management, means meets all the requirement and the criteria, which board should confirm. And once appointment is done, it shall be formalized by issuing a letter of appointment, which is a mandatory requirement for an independent director to appoint. Just for the information that certain professional bodies maintains a data bank for a person who are eligible to get an appointment of an independent director basis their eligibility criteria and qualifications. Company may choose for that, choose a person from that data bank. However, it's an optional and not a mandatory. Now, from here, our real discussion starts. I just take our discussion back. As I mentioned, that independent, the word is very important, because the director sits on the governing body of the company, the governing body who is independent to the management and make sure that overall functioning, objectivity, risk management, business, policies, procedures in place are working fine and operating effectively, are designed well, and there are no risk attached to it. Therefore, it enhances the roles of an independent director, and it shoulder them with additional responsibilities. So an independent director should be having a high value, integrity, and ethical standards. He should be very objective and constructive in all the meeting minutes and in all their discussions which are relevant. He should act in a bona fide manner, as I mentioned. He should be unbiased, impartial, and responsible to the stakeholders, shareholders of the company, and not to the management. He should be devoted, attending all the meetings, and take balanced decision. Do not abuse the position by giving or making those decisions which are not in the interest of the members of the company. He should refrain from any of those actions which can lose his independence. Again, a very important aspect to understand. As an auditor, A prime responsibility is that we are independent before we get an appointment and throughout our appointment when we are acting as an auditor at an individual level, at a firm level. The same responsibilities goes to an independent director, that any point of time he does not lose his independence. We discussed in section 149(6) how it is defined. And he takes all steps and provide his assistance to make sure that best corporate governance policies are in place, are followed by the company consistently. So these are some responsibilities which are shouldered on an independent director. Role and functions of independent directors. Again, a very important aspect, which is defined in Schedule 4 of the Companies Act. First is independent judgment. As I mentioned, independent director attending the board meetings or any other committee meetings of the boards should have an independent discussion, analysis, and a judgment about company's risk, policy, procedures, functions, business strategy, etc. And they should have their independent view to give their own thoughts and to reach on appropriate decision. He should be objective in the board and to make sure that he is evaluating the management performance appropriately on a timely basis, on a regular basis, and monitor the management performance vis-a-vis the manners, the instructions given, the actions taken by the management, and output given by the management. It's very important. Independent director also act as a financial controller to the financial health of the entity. If I just take a pause here and discuss this point in detail. We all are aware that in case of a listed entities and other public entities, there is an audit committee which is comprises by independent directors. SEBI, RBI Companies Act defines that audit committee composition should always be more than 50% by an independent director. An independent director makes sure that the financial health of the company is strong, adequate, and it is supported by internal financial controls which management has put in place, and there are no concerns to it. Their roles and functions also goes towards to make sure that they are safeguarding the stakeholders' interest, especially the minority shareholders. As I mentioned, they are not responsible to the management, they are responsible to the shareholders of the company. And therefore, it is very important, being a part of a governing body, they make sure that all the decisions, what has been taken by them, and all discussions which has been placed by the management are in the better interest of the shareholders and the company. Balance the conflicting interest of the stakeholders, of course. Independent directors also plays an important role in determining the remuneration of key managerial person, senior management, top management, including appointment vis-a-vis their removal. And therefore, their presence becomes more significant when they came to know that certain management verticals or certain management functions are not in beneficial to the company or not performing their duties as expected, and therefore if they can take an appropriate action either by removing them or giving them a strong feedback. So that's why a concept of nomination and remuneration committee is introduced. We will discuss that matter in upcoming slide, where again it is mentioned that it should be well placed by independent directors and their numbers should be more than 50% of the total required numbers. Act as a balancing authority between the management and shareholders' interest. Being a governing body, they are attached to the company and therefore they should need to be balanced on the management view vis-a-vis the expectation of the shareholders and the investors. So in a nutshell, if we look at these roles and functions of an independent directors, what is important here to understand is that their job, their responsibilities, their roles are beyond the management functions and to make sure that overall functioning in the company is appropriate as per law and regulation. It is in the interest of the shareholders and they are taking all decisions independent to the management. Duties of independent directors. Again, if we look at their responsibilities, their roles and functions, their duties, all are interlinked, overlapped, and coordinating each other. An independent director should always be updated with set of skills, knowledge, and experience with the business and entity in which the company operates. And they should always have a familiarity with the business of the company. For example, there is a lending institution, a bank, but in bank, no independent director has a past banking experience or not pertains to the banking industry. Might be their decision-making process will not be effective in that banking company. So it's very important that they are belongs to that particular that industry. They are regularly updated and they refresh their knowledge and skills, which can enable them to take appropriate decision making. Independent directors also play an important role in managing the company's function in a way that if any action taken on the company by regulator or a whistleblower action or any fraudulent action, an appropriate resolution of the same is drawn. So they have a duty, and at the same time it becomes their right to appoint an outside agency or a consultant or a law firm to perform an independent investigation in the company and submit their report along with their observation to conclude on the matter. For example, we read in various newspapers that in some of the companies, some whistleblower matter has come or some fraudulent activity has happened or some matter has been raised by shareholders against the management. Then that point of time, it is the duty of the independent director to take cognizance of those matters and make sure that those matters are appropriately resolved, and if required, they need to take help from professional bodies, consultant, law firms, etc. to investigate those matters. Of course, since they are appointed on the board, it's their prime responsibility. They attend all the board meetings, all those meetings, which are the committees of the boards where they are members, and they participate constructively. Their presence should be well recognized and their matters are well absorbed. Since it's a combination of different sets of people and expertise, there could be some matter of concern which needs to be addressed by the board. So an independent director makes sure that if there is any concern on the functioning or any other matter of the company or any other matter which has come in the discussion in the board meeting or in any other committee meeting is well addressed up to by board of directors. And if that matter is not well addressed or resolved, sorry, if that matter is not well addressed or resolved by the board, that is well recorded in the minutes of the meetings for the further action or for the further discussion, or just to make sure that their concerns are recorded for any regulatory review or for further discussion. But that duty is and that job is of independent director to make sure. As an auditor, we always concerned with the understanding of the entity and its environment in which it operates, because it's a risk assessment tool for an auditor. If you don't understand the entity and the environment in which it operates, it won't be a good planning for an audit engagement. Therefore, the similar applies to an independent director. When an independent director operates and appointed in a company, his duty is to make sure that he is always updated with the applicable regulations and the requirement of the company and industry in which that company operates. Means the knowledge of external environment. Very important for an independent auditor. It's very important. Point number 1 on this slide. Related party. Um, we have heard various issues that India has faced in large corporates in previous 7 to 8 years, and collapse of those corporates because of large group companies and because of the related party transactions. And after that, all regulators, including RBI and SEBI, has become very, very particular to the related party transactions. And that's how the same responsibility is now on the independent directors, that they must pay a sufficient attention. It's very specific, given in Schedule 4. They must pay a sufficient attention and ensure adequate deliberation on each related party transaction before approving the same. Because there is a requirement under Companies Act that such related party transaction shall be approved by audit committee and the board. And in both audit committee and the board, since independent directors are there, they must discuss related party transactions, their arm's length, their objectivity, why such transactions are done, and their approval, and the nature of such transactions before approval. This is very specific, which is highlighted. Though they deal with various other financial statement line items or other non-operational or operational functioning of the company, however, it is from the financial numbers perspective or the financial disclosures perspective, related party is very important, and this is specifically shouldered on independent directors to address this matter. Independent director must ensure that there is an adequate and functional vigil mechanism. If there is any whistleblower or any fraudulent matter, there is a perfect vigil mechanism exists in the company which can take care of those matters and which can properly address those matters. They should always report their concerns about any unethical behavior or actual or suspected fraud which has come to their attention. If they believe that certain fraud has happened, as we just discussed in the previous slide, they have a duty vis-a-vis the right to appoint an external agency to go into their RCA root cause analysis to make sure that why this has happened and this is not repeated in the future, and to take an appropriate actions against those who are involved from the management side or any external party. Since these are independent directors, and if we compare our position as an independent auditor, we have an important clause which is of a confidentiality. If confidentiality is not well maintained, it can result into losing confidence of outside world in the profession. Similarly, for independent director, it becomes more important. And why it becomes more important? Because they discuss all the key objective, future or present matters of the company, and they have all idea of the company. Any release of such information to the outside world can be interpreted in any way or used in any way, and therefore their role becomes more important, that they maintain the confidentiality of the information, including the technology, business plans, UPSI, unpublished price sensitive information, where SEBI has issued various circulars. Until and unless such disclosure is required by regulator or approved by the board to disclose in the market. That's why the confidentiality clause is very important. We discussed the last point in the previous slides also in terms of the roles and functions, but at the same time it becomes their duties also that they should act in a legitimate way to maintain a healthy, a balanced proposition between the management, directors, and stakeholders and employees of the company, and also to protect all of their interests to make sure that there is a ethical governance exist in the company. Other consideration. It goes in their duties direction. Independent directors shall hold at least one meeting during the year in the absence of non-executive director, non-independent director, and management. And in that meeting, they should assess the performance of non-independent director, board, chairperson of the company, management of the company, to make sure that there are no objectivity issues and there are no biasness exist and my company is functioning properly. This is a mandatory requirement and meeting should be well recorded in the minutes of the meeting, as mentioned in Schedule 4 of the Companies Act. In such meeting, they should also assess that the quality, the quantity, and the timeliness of information provided by the management is how much effective, reasonable, and whether management is giving all required information to the independent directors, to the board of directors, to other committees of the boards, as and when it is warranted, as and when it is required, to make sure that there is effectiveness and reasonability in their performance. So it is also responsibility of an independent directors to make sure that the flow of information, the quality of information, the timing of the information, and the objectivity of it. When so many responsibilities are given, it is also very important to understand that what if independent director does not discharge their responsibilities with or in a way it is expected. So an independent director shall be held liable for their act if it is proved that such non-compliance or omission or commission by a company has occurred, has happened, where independent director had a full knowledge or connivance, or it has happened because their failure to apply a proper due diligence in that matter. Then an independent director will be held, their responsibilities will be fixed, and it is well defined under section 149(12). So it's very important for an independent director position to work in a way that they discharge their responsibilities. If you look at the appointment of an independent director, which is slightly different from an appointment of an executive or an whole-time director. Their appointment is always for original terms of 5 years, which is consecutive period of 5 years and considered as a one term. If company and the board of directors propose a further appointment of the same person for another 5 years, which is another consecutive term, that can be done by passing a special resolution in the general meeting of the company. So an independent director can maximum hold a position or the office of an independent director for a period of 10 years. Important to understand here, if a company propose first term, say for example 3 year and not for the 5 year, it would be construed as one term and person will not be eligible to get a point for another 2 years, means 3 plus 2 equal to 5 will not become one term. The 3 years when initial appointment has been happened, it will become 1 year, one term. So in a way, a person can be appointed as an independent director only for 2 consecutive terms. Each terms can be of maximum period of 5 years. There is a cooling off period of 3 years for the purpose of reappointment, and their tenure is always non-rotational. Remuneration. Since independent directors are responsible to oversee the governance function independently, it's logical that their remuneration should not be linked in a way that it can impair their performance, objectivity, independence, or biasness. That's how the remuneration which is defined under Companies Act for an independent director is that they are not entitled to get any stock options. Their remuneration would be given by way of a fee element. They are entitled to get reimbursement of expenses for participation in the board meeting and other committee meetings. And they are entitled to profit-related commissions as may be approved by the members, means the shareholders, and not by the board. If that is there, they can get some profit element in form of a commission of the profit element. But other than that, a company cannot pay any money to the independent directors. As I just mentioned, that directorship is defined in Companies Act, in SEBI for listed entities, SEBI LODR regulation, RBI for banks. Now RBI is also introduced for NBFC companies. So if you look at the committees which are defined, the board of directors, which is quite obvious there, audit committee, nomination and remuneration committee, we discussed this, stakeholder relationship committee, corporate social responsibility committee, and risk management committee. You can see that in each of these committee, what are the minimum number of an independent director is defined. For example, Companies Act says for the companies in the board of directors, minimum 1/3 of the total board of directors should be an independent director. While SEBI says if chairperson of that board is of that company is non-executive director, then minimum 1/3. If there is no regular non-executive director, then minimum 50% there should be an independent director. In top 1000 companies, earlier it was a 500 companies, the regulation changed and it became in top 1000 companies shall have minimum one woman independent director. RBI for bank defines minimum 50%. Now the question comes, for example, there is a bank, it's also a company. What to follow in terms of the regulations? The Companies Act, which defines only 1/3, however, the RBI says minimum 50%. Answer is very clear. Whatever is stringent and more challenging needs to be followed with. Means a company which is a banking company need to have minimum 50% independent director in their board of directors composition. Companies Act does not define for the stakeholder relationship committee and RMC. However, SEBI defines the position in stakeholder relationship committee and RMC. Nomination and remuneration committee, we discussed, it was one of the important role and function of an independent director. And I highlighted minimum 50% of members of such committee shall be an independent director because they are managing the remuneration, removal, appointment, appraisal of top management, senior management, key managerial person. So it should follow an independent process. In the similar way, audit committee, who monitors the large functions of a company, including the financial health, the financial numbers. If you can see this composition, all regulators follow the similar directions that they should have more than 50% or 2/3 in case of a SEBI or RBI independent directors of total required members. So this is more kind of an information, but the idea to give that how regulator has defined and has enhanced responsibilities of an independent director to make sure that the functioning at the governing level is very objective in the interest of the company vis-a-vis in the interest of the shareholders and not biased. So thank you. That's all from my side on roles and responsibilities and powers of independent directors. Thanks for all questions hearing, and happy to take any questions on this subject matter.
मैडम क्वेश्चन नहीं है सर, एक भी क्वेश्चन नहीं है सर अभी तक।
There are no questions?
नहीं सर।
Okay.
आपका साउंड नहीं आ रहा है।
If there are no questions, that's fine.
क्वेश्चन नहीं है एक भी सर अभी तक। सर मैडम आपका साउंड नहीं आ रहा है। सर आपका माइक चेक करिए, माइक ऑन ऑफ हो रहा है।
So then, shall I disconnect?
एक क्वेश्चन आया है सर, 2 सेकंड सर दे रहा हूं सर। क्वेश्चन दिखा सर आपको सर? हेलो हेलो।
Yeah, so the question is fault liability can come on independent director. Any example that have happened? See, there are certain examples. I don't know, I'm not sure whether naming is correct on this forum. But in terms of a liability, an independent director can be responsible for the further investigation, arrest, or the penalty to be paid. In certain cases, it has happened that independent directors are being investigated and detained for the functioning in the company. I'm sorry, I could not take names. I don't think it would be okay to taking names on this forum.
सर लास्ट वाला क्वेश्चन देखिए सर, लास्ट वाला।
हाँ, मैंने उसी का रिस्पॉन्स, I have responded to that question only.
Thank you. Sharon madam.
Yeah, now you can hear me?
Okay, ma'am.
Yeah, okay. Yeah, okay. On behalf of WILC, I would like to thank CA Prateek Khandelwal sir for being on this session today. And in fact, all the faculties of our 3-day session refresher course on Companies Act 2013. And it was been such a great event. And I would like to appreciate all the members who are present over here till the end of the session for this 3 days refresher course. And I believe we would meet for the future endeavors also. I would like to thank all the faculties once again. Thank you, sir.
Thank you, Sharon. Thank you.